Good morning and welcome to Trade Live with IG. Today I'm Luke Moore and I'm joined in the studio today by my colleague, Rich.
Very good morning to you, Luke. It's nice to be here.
Yeah, thank you for joining me on this important Tuesday.
A very busy Tuesday, isn't it?
It's busier than you might think it is.
Well, that is true, because I'll tell you what I'm looking at. I'm looking at Monkey Man saying he's thinking about selling his Nvidia.
Brave.
Breaking news.
Brave.
There's analyst downgrades, and then there's Monkey Man saying that he's going to sell on Nvidia.
Oh, everyone needs to get out then. Surely everybody needs to get out ahead of Thanksgiving. Is that what it is? Try and get out before.
That's exactly what it is.
Quiet week.
He also says that Ange clearly hasn't done her makeup yet.
Very kind. There is a makeup bag around here somewhere, though. It's a very busy.
Plenty of makeup around.
It's a very busy desk this morning, so we're trying to work through.
Talking about making it up, I am in trouble, Luke Moore.
Why?
I forgot an anniversary last night. Now, and it was even worse because it looked like I had remembered, because I messaged her and said, "Darling, I'm going to make some mushroom risotto tonight. That's my speciality." Bit of goat's cheese in there. Oh, incredible. So she thought I'd remembered. So she gets home, you know, and I cheersed, and I can't remember what I cheers to, but it was something irrelevant.
Yeah.
You know, and she was waiting for the happy anniversary.
And it didn't come.
So the dinner kind of went a bit sour, but she still didn't tell me what it was. Anyway, an hour later, you've forgotten our anniversary.
That's unforgivable, but I will give you credit.
Thanks, mate.
I will give
me up.
No, I know. Only because I know I would get absolutely murdered as well. No, but you made a beautiful mushroom risotto. I mean, Come on, look. If that's a normal day that you just whip up, you know, just a fine kind of goat's cheese risotto, you know, that is
a normal Monday.
Yeah, exactly. It's a Monday.
I think I kind of rescued it because, you know, I said, "Oh, but I thought our anniversary was the 25th." Right. And she said, "It is the 25th." So that I kind of got away with it in that, I thought the 25th was Wednesday. Not that I look at the date every day on a trading system or anything.
Yeah, it's a bit different than when you look at it on a trading system versus look at it and, you know, in your own personal diary. See, I got married last year and the anniversary has changed. So we did originally have a date where we'd first got together and said, right, this is going to be, you know, our first date. This is our anniversary. And now it's changed. So I got in trouble because I missed the old anniversary as like a little, you know, do you remember this is what we used to celebrate?
Right.
So I just can't get next year wrong.
Yeah.
That'll be the
well, 20. Okay.
have to be very careful.
Add to calendar 25th of November next year. So yeah, but I missed an opportunity because the opportunity was clearly at the same time. I could have said, "While you're mad at me anyway, I may as well tell you I've gone ahead and watched the rest of The Diplomat without you," and then just get it all out, and, you know, I would have been sleeping in the spare room. But
it's good, isn't it?
Yeah, but I've still got that to come.
It is good. That's my partner, my wife, she unsubscribed from The Diplomat kind of about a third of the way through. So whilst we were both watching it, I think only I was really watching it.
Interesting. Yeah, my sister the same. I think it's fantastic.
Agreed.
Right, but apart from that, you know, things are good. Apart from the spare room not being as comfy and very cold.
Did you go and see Wicked at the weekend? A lot of people did.
No, I didn't. How was that?
I haven't seen it either. No, I haven't. But we sit in a green screen studio, and of course, Wicked is the Wicked Witch of the West. So I just wonder whether you'd, as a big cinema aficionado, I wonder whether you'd gone and made the trip.
No, I didn't, but I did speak to our head of marketing, Chris Old. And Chris, if you're watching on the train right now, I apologise for this, but I said, "Chris, what are you up to at the weekend?" And he said, "Off to see Paddington 3. And I was like, "Oh, that's great. You taking your nephews or nieces?" "Nope." just going to see Paddington 3. So Chris Old, tell us how it was. Let us know.
Good, clean family fun.
Yes.
On his own.
Right, what have we got coming up today? I hear you all ask.
Markets wise or on the show?
Well, on the show.
On the show, I don't know who's on. Me. I'm here for the first hour. So I'll be doing the first piece, watching the markets open with yourself, and then the confirm and send.
That's right. And then we have Tom Wolstenholme is coming to sit with Ange at 8:45. And then a good old friend of the show, one of the first guests I ever had on was Jack Maguire.
Nice.
So very happy to say that Jack Maguire is live from the trading floor.
Nice.
Later on. And yes, guess what today is?
It is.
We know it's the 26th of November.
We know it's the 26th
I
of
know
November.
that.
It's a Tuesday.
It is.
Arsenal are playing away to Lisbon this evening in the Champions League. Is that what we're celebrating?
It's not. We could have been celebrating West Ham last night, but there is something else we want to celebrate, and that is the last day of producer Fred before he goes off on holiday. We are, when the cat's away, the mice are going to play. Oh, yeah.
Good luck.
So please tune in the next few days. We've got Wednesday, Thursday, Friday, Monday, Tuesday of no producer Fred. In fact, no producer at all.
Wow.
Because we don't have a backup. So it's going to be a lot of fun.
Good luck. Would you know where he's off to? Where's he going on his holiday?
Well, put it this way. He's going to tune in tomorrow and be, seeing what's going on and be choking on his baguette.
Right.
So, he's going off down to France for a nice long weekend.
Well, we wish him a lovely trip.
Right, on that note, let's go into overnight action.
Plenty going on overnight. Plenty going on. I think you probably have to start with the biggest story of the evening. Is we are back to public policy via social media. is the only way I can describe it. Trump has been on his social media site, Truth Media, and he's now, shooting off a bit more detail about the tariff conversation. So the headline is that he said, and I can get the quote on exactly what he said, unless you've got it
let's
here.
get you get the quote up, and I'll quickly show the Asian equities that are mixed after those Trump tariff plans. So, it's the big hit is on, of course, Mexico
and Canada. Yeah. So 25% tariffs on all imports from Mexico and Canada, and an additional 10% to what already exists for Chinese products, which actually is a lot less than he was threatening during his election campaign. So if you recall back from the campaign, he was talking about 40% tariffs on anything coming in from China.
Yeah.
And now he's only giving an extra 10%. Now, this is probably an escalate to de-escalate negotiation tactic.
Absolutely. But it hasn't stopped the currencies moving, hasn't it?
No, it hasn't.
Wow.
So the Canadian dollar is off about 1%. The Mexican peso off worse by the looks of it. 1.4%. So
we show that one. Not that we are big traders of the old Mexican peso, but you can see exactly to the minute that came out and how much of a shock it was. Then
does the Mexican peso against the dollar have a nickname? So you know how obviously we get cable, you get euro dollar. I suppose euro dollar it's not really a nickname. The Canadian dollar, the nickname?
Loonie.
The loonie. Yeah, exactly. I don't know. Does the Mexican peso have one?
And there's our loonie on screen right now. So all those moves. Then they tried to come back because everybody remembers that
it wasn't quite as bad as.
And it's a negotiation tactic anyway.
Yeah, exactly. It's a negotiation tactic. But between China, Mexico, and Canada, that is 40% of the imports going into the US.
Wow.
So it's a big number of goods and services coming in. So, but clearly, if you look at the Canadian-Mexican peso cross, the biggest loser is Mexico in all of these conversations. And I think what Trump was talking about, he's talking about its ridiculously open borders. It harks back to kind of a build the wall type of rhetoric. He specifically mentioned things like the drug crisis and fentanyl and all these drugs that come across from the south into the north, which is why I think Mexico's and the Mexican peso has clearly taken more of a hit. Interestingly, I mean, we've seen kind of since Sunday or since the weekend reporting about Basant coming in as the Treasury Secretary. It's an interesting reminder to show you who's boss. Trump sends off not a tweet, what's a Truth Social?
It was almost, he didn't like the way the press and my own TikTok was moving towards saying, right, well, that's it. That's the world is almost going to go back to a normal place. The chance of tariffs has lessened. And just when we all thought there was a chance to make good money on bonds, on the euro, on the German autos, then boom, he
Reminds you who's boss.
yeah, exactly.
Question for you, which sectors do you think are going to be the biggest affected? So if you were a stock picker, or if you were a fund manager and you were trying to allocate kind of overweight and underweight positions as a result of this, what do you think are the top 2 or 3 sectors in the US?
On the tariffs in general, or just on the headline last night?
So on the tariffs in general, so if you're thinking that 40% of imports come from China, Mexico, and Canada, what kind of things are we importing? What kind of things do they talk about?
Avocados.
Actually, no. Apparel, running shoes, apparently, are taking a big hit. So they've seen.
That's why Nike was up, I think, 2% yesterday, before the headline came out.
So we might see a bit of movement on that. Toys, interestingly, furniture, household appliances, and things weirdly like toasters, mattresses, all sorts of strange different things. But I think this is more of a development around the policy that already exists. You know, there is. We're talking about, you know, Trump being the only person that uses tariffs. However, we know that there have been, I think there is 17% tariffs on anything coming in from China at the moment, and that's been a policy that the Biden administration brought in. So tariffs aren't new, and tariffs aren't something that is going to send shockwaves around the global, the kind of global trade discussions, but it's just being developed.
Having said that, Europe straight away have taken the opportunity to also talk about putting tariffs on China, you know, which has been ongoing, but there has been comments there overnight as well. So yeah, the tariff story. Let's see how that is leaving the futures and what we're looking at this morning. The FTSE taking a bit of a hit as it was just primed and ready to break out yesterday. It was ducked above 8,300 last night. It's down 35 basis points. Eurostock's down 60, and the DAX hurting me as I've got a little DAX long there from yesterday, down 50 basis points. You can see Bitcoin really got a hammer in yesterday, 93,700, probably where it was on Thursday or something like that. And then, yeah, that obviously hit the crypto stocks as well. Copper, not great. Copper back down 70 basis points, 412.
Dr. Copper.
Dr. Copper. And gold continues to see the sell-off that we spoke about yesterday. And yeah, so that is now 4%, more than a 4% move in that 24, well, yeah, since Friday's close. Now, let's have a quick look at how those all sessions moved. See how MicroStrategy down 6. We had Riot Blockchain down 3. Taiwan Semi down 3. Of course, Taiwan Semi being the supplier of our good friend NVIDIA. It was down almost 5%. And that's why Monkey Man is thinking about getting out. Doesn't like that move.
Do you see what else moved last night? Zoom. So Zoom had their results last night. And I was diving into the expected move, strangles, and everything that came in.
Oh yes.
I was quite surprised to see the IV rank. So that's a piece of data that Tasty and the options platform, it ranks the volatility against its own historical volatility.
So useful, isn't it?
So useful, and it was up at 127.
Was it really?
Which is basically saying Zoom's probably the most volatile it's ever been, and you can see. Look at this huge run that we've had up from around, is that $55?
Yeah, well, but let's just keep things in check, right? Let's remember where this thing came from back in those good old days. Yeah, look at that. I could keep going. Yeah, let's go out to a monthly, actually, and have a look at that.
Yeah, there you go. So they've said that they
Did you trade that at all during COVID?
Oh, we brokered a lot of that stuff. Yeah, loads of it. I mean, it was part of that contingent of vaccine stocks. Peloton was another one. Zoom, it was just, so active. But Zoom are going to be, you know, they are weak to Microsoft's ability to just steal technology from absolutely everybody. Now Teams, calls, everything that comes with it. I struggle to see where Zoom's USP is.
Yeah.
However, they did say that they are raising their forecast for revenue for the year, and they had a better than expected earnings per share. So good for them.
Great. Right, we can take that horrific mountain. That does remind me, actually, because I was in the mountains during COVID for that two-year period. So that's just like the view I could see outside my window.
Down in New Zealand, lovely.
Speaking of which, do we have Ben Buswell on the chat? Yes, we do. Morning, team. There we go. Now, fantastic news. This boy has invested, traded. He's made a good amount of money on Upstart. As he's mentioned in there. He's taken it out and he's gone and bought a shop with it. He's bought a sports shop called Sterling Sports down in Queenstown.
Nice.
Now that is a success story I like to hear. Well done, my boy.
Yeah, and Ben, I actually do have your email in my inbox that I need to come back to you. Apologies that I haven't emailed you back. That's portfolio diversification for you.
That
there you go. Upstart into a startup.
Ah, very good.
There you go.
Very good. Sports startup. Off we go. So, yeah, Sterling Sports. Are you going to rename it, Ben? That's what we want to know. Monkey Man saying Bill Ackman has been buying Nike. That was in H1 though, wasn't it? He's had a bit of a shocker there, but we do think that comes good at some point next year. Just tricky to time that one. It's probably now there was another stock yesterday.
There was a story in Qualcomm. Did you see that one?
Yeah, Qualcomm.
So Qualcomm have been mooted that they were looking at Intel for a little while. I think the story broke maybe 2 weeks back that they were looking at them, but they've now said that they are probably not going to look at them. So they've called their interest, primarily due to the complexities and challenges associated with such a large deal, including, and I think this is potentially where we'll start to see more weakness. You typically see a stock weak if the bidder walks away, because you would expect the premium to be put into the stock as the story breaks, and that's going to come out. But they've said they're walking away because of the challenges of doing the deal and their significant debt and operational hurdles. So they've had a little look under the hood and have gone, no thanks.
Oh, that is. Oh, right. Remember, everybody, let's look at all sessions at 9 a.m. this morning. You got that, producer Fred? Or are you off getting your sun cream already? Yeah, all sessions 9 a.m. Let's look how Intel reacts to that. It's not going to be pretty.
Nope.
What have we had reporting this morning? Talking about getting on his bike off on holiday. We have had Halfords, haven't we?
We have, yeah. So look, if we're going to start looking at some UK stocks, we've had Halfords come out with their pre-tax profit for the first half of the year. It is bang in line with £21 million. Their revenue was down 1% year on year. Their interim divvy per share is exactly the same as it was last year. And this is where I think it could be quite interesting to keep an eye on. Halfords have come out and said their trading look is uncertain following the UK budget, and they're saying that the second half of the year is impacted by short-term costs. So I don't know if that's the first time that's been mentioned, but it's certainly, well, when you start to talk about stocks and you start to talk about movements, you want to look at their guidance.
Yeah.
You'd argue that it's better to talk mean and then so under promise and over deliver. So perhaps they're using it as an excuse.
I think it's such a freebie for everybody, isn't it? So as soon as Tesco's was up on the front page of the Times with 1 billion additional costs, even though it was over a 4-year period, you know, I just think, because you can see since the budget, we've seen Halfords drop from 165 down to 130. So, you know, we're at quite an interesting support level there, actually, on the stock. Back, the 124 level. So that's going to be an interesting one today. Will there be a little bit of relief?
See if I can get any early calls.
Yeah.
So we have, they are being called unchanged on that.
A big fat unch.
A big fat unch for a very inline So very in line.
Do we have a move on AOL World?
Yeah, so the other one that have been out this morning, I suppose in a similar kind of consumer goods type of sector, is AOL, the appliances online. They're being called up 3% as an early call. They also mentioned the budget. So again, you're saying this is a freebie. Everyone's going to jump on the bandwagon and say, look, costs, we don't know where it's going to be. But they had their full year revenue came in line with 1.09 billion. They've said that they had a decent set of growth in the B2C sector, 13% up in the B2C sector year on year, and they've made sufficient progress to maintain their margins at 5%.
Just remind everybody at home what they do, because people, of course, automatically go, as soon as they see AO, they think, is this the old AOL?
No, definitely not. No. Washing machines, dishwashers, anything to do, it's AO is appliances online.
Appliances online, that's what it stands for. Not Angeline Ong's World.
Not Angeline Ong's World, no, not
Wouldn't that be a fun place?
It would be,
I think we have the music of Angeline Ong's World. So I phoned Luke last night because he was on the lates, and we're just talking about doing an order in one of the stocks that's reporting today. But to get through to Luke, I was put on hold, right? And I haven't heard IG's on hold music for a while. But here we go. We've got a soundbite for you here.
It's not good, is it?
Is that? I mean, let's do a little role play here, right? I'm an angry customer. So you, Luke Moore. Wait, what's happened to my trade? I'm really annoyed. You've messed this up. Like, I demand to speak to a manager now.
Do you fancy listening to some slightly high-pitched windpipe music? That will help you calm down. No, that does need to be looked at. So we tried to come up with some ideas.
Yes, we did. We tried to come up with some ideas, but we want you at home to come up with an idea. What soundbite do you want to hear when you're on hold at IG? What would you like to listen to? Give us ideas in the chat, please, right now, because Luke Moore came up with a great idea.
It was, which was it? Was it Ain't No Mountain High Enough? So we're talking about, growth. We're talking about, the market's moving up. Ain't No Mountain High Enough. What was your one? You had
some of my stocks that have done that and then that. I quite like Fly Me to the Moon, because I think it should be something finance related, Wall Street movie, that kind of thing.
Yep. So any ideas like that, we'll have to go and pitch to our global head of client servicing to see if we can buy the rights to the music, because I imagine that's what we'll need to go and do to then improve your lives when you ever need to speak to us. But hopefully we never put you on hold, because we would only do that if we need to go and look into something, and you can fly straight through to one of our client service agents.
Exactly. Right. So Andrew McKelvey saying on Halfords, they've done well. Cash, comfortable with full year 25, but the TPT results don't read too well, Andrew. So we shall have a look at that as well. And our first suggestion of music, The Only Way Is Up. That is a good one, unless somebody's calling because they've got a short position on. But yeah, the only way is up, baby.
Yeah, and I agree with you, Coach Carter. Do our best not to put you on hold, but if and when we do have to, and we will try to call you back if you're on hold for a long period of time. I will back up my guys, but yeah, we just want to make sure it sounds better.
Here we go. Don't stop believing. That is Mark Carberry's shout there.
Right.
Maybe I won't sing anymore. I promise not to.
Topps Tiles. Oh yeah, they look a little bit bad. So Topps Tiles posted a 50% slump in annual profit on Tuesday, hurt by weak demand in home repair and maintenance as broader economic woes continue to weigh on customer spending. Not good. Where are they being called?
Right, there we go. If anybody wants to read the full story there. Geez, yeah, that is. Now, obviously, Kingfisher yesterday, right, down 15% in the end, Kingfisher. Then we're seeing this. In the States, we saw Target down 25% last week. So, there is certainly, people feeling the pinch on interest rates now when it comes to houses.
It does seem to be. So Actually, Top Styles is indicating in the opening auction just down 1.2%, but that's only on crossing in 5,000 shares. So I think that's going to probably change.
And with 5 minutes to go to the open, we'll take a quick 3-minute break and we'll be back with all the upgrades, downgrades, pre-market prices, and some more songs. Let's go to On Hold.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. It's based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
And we've been looking at the other stories that we missed. We've also seen an update from Compass Group this morning. We've also seen Cranswick, and we have also seen Intertech. So we're going to keep an eye on these guys at the open for you.
And you've also seen an update from your wife this morning, haven't you?
Yeah. This. Look at this. Look at this. I can't do anything about it, unfortunately.
Just messaged him, fix your hair. So good morning to
Emma. Well done. Thank you very much.
No?
Mrs. Moore, yeah, Emma. Yeah, I am actually going to get my hair cut tomorrow, so thank you very much.
Good stuff. Right, upgrades, downgrades. Let's have a look at, well, ThyssenKrupp. ThyssenKrupp is a mover, down 1.4%. Risk losing more jobs over energy costs it talked about yesterday in the evening. The German autos are going to get hit on the back of Mr. Trump. Thank you very much, because I've got a long position there as of yesterday. VW down 1.9%, and of course they've got the production plant in Mexico. So the autos that produce in Mexico are going to get hit as well. You were looking at GM, weren't you?
Yeah, there was actually a couple of cool stories yesterday. So GM General Motors, I'm cautious that the bell is about to ring. So maybe.
Oh, no, don't worry. We got 30 seconds.
30 seconds. General Motors and Cadillac have just struck a deal with Formula One. So actually, General Motors is bucking the trend. They've been in an incredible uptrend since the middle of last year.
Oh yeah, we got that graph actually.
Yeah, and so GM, Cadillac, for any F1 geeks, Cadillac took on the Andretti bid last year, and it's seemingly good for GM.
I mean, have a really quick look at the chart. 3-second look at the chart. Show us GM, and then it is boom, and then we can go to the bell in
1, go.
Look at that. We got the opening bell. We're ready to rock and roll this morning. The UK market open. What are we going to see? How hard am I going to get hit in these German autos? It looks by about 1% first thing. Anheuser-Busch also down 1.5%. I would imagine also on the tariffs. The mining stocks, yeah. Oh, Compass down 3.5%. Compass Group have also had numbers there.
Compass Group have had numbers. Let's just rustle through those. Their operating profit actually met estimates. The market was looking for 2.98 billion. That's 2.98 if I can talk properly. $1 billion in operating profit. They made 3, so bang in line there. Their organic revenue was up 10.6% year on year. They've upgraded their organic revenue. So that to me looks like a good set of numbers. But the stock, we're clearly missing something there because it's sold off.
It has had quite a good year so far. Let me just, so I'll show you the chart. Oh, dear me. Let me show you the year to date, which we've got a funny on. Martin Harris can get rid of that for us. But you can see it's had an amazing 3 years, actually. Absolutely incredible 3 years. So there are high expectations in there. That has just come off the top. But I didn't actually know. I haven't looked at Compass. Was one of the first stocks that traded back in 2004, joining the desk. Jan-Paul Charlotto, big trader in Compass, the biggest on the street at Credit Suisse at the time. But that stock recovering from 2021.
Yeah, interesting. They were being called up 1% as a pre-market indication. So the market has got that one wrong. So potentially a couple of people just offside on it.
Right.
Down 3%.
Okay, so let's get back into seeing how bad these European autos are this morning. So Peugeot down 1.7, BMW down 1.7 as well, Porsche. So that is a shame because that was looking like a good trade yesterday. Wow, Halfords up 8%. So there we have it. That shows just that how much worry was built into that name with Kingfisher. So a relief there that they haven't warned by the looks of it.
Good for them. I think if we look at so you mentioned Anheuser-Busch. Diageo also struggling this morning. They're down 3%. So potentially another one of these companies in the UK that is going to be stuck by exporting into the US. But I've got Sean messaging me from the desk. They're seeing big moves this morning in Melrose. Melrose are next, actually, at the top of the FTSE 100. Melrose, they were upgraded at JP Morgan. So Melrose is currently trading with a.
You see a bit in that, do you, Melrose?
Not as much as you might expect, really, but they're up 5.6%. So they were given an £8.50 price target by JP Morgan. So what's that, a 30% upside?
Well, it's a nice breakout as well, isn't it? It's closing that, it's not a gap, but it is a leg down from back in July.
Oh yeah, nice, right back into previous support. Happy days.
Yeah.
So that wants to hold and close above to try and reclaim.
Yeah, let's get a little bit of a closer, zoom in on that. Look at that. That is, that's an interesting one to watch. I wouldn't necessarily do anything. I'm not going to trade it because I've never traded Melrose before in my life, I must admit.
No.
But yeah, we can see that there's some research of the day. Kingfisher cut target price to 235. I hadn't seen that. That's below where they're trading. JP Morgan cutting Kingfisher. Melrose there is JP Morgan up to 850.
I think the other big performer that we've seen is Next. So Next are at the top of the FTSE 100. They're up almost 1%. They caught an upgrade from RBC. They're currently trading £99.20. They were given a
what was it?
£108 price target. So that's a 10% or so lift from where we are now from RBC.
Wow. What an incredible compounding stock. That is just the story around Next is maybe shall I just show a quick sort of 15-year chart there, because this thing, if you want to find one of the best, you know, this could be our Elon really. Look back from 2010, going from £20 up to £100 over that 14 years.
Plus, I imagine a fairly healthy divvy.
Well, that's true.
Look on fundamentals, see what the yield is.
I think I would guess 1.8%.
We have got a dividend yield of 2.2. So 2.2 whilst the stock is growing, so therefore it's increasing its dividend as the cash is, as the stock price is increasing, for that yield to therefore tick up.
So it's probably about another at least 40% on dividends. In that time.
It's a big call calling the next Elon, though.
No, Simon Wilson.
Simon Wilson.
Simon Wilson is the original Elon, before Elon was even out of. Where was it he started? It was PayPal, wasn't it?
So he founded, PayPal was the first, wasn't it?
Yeah.
Let's just keep an eye on those Compass and those Diageos. They're skirting around the bottom of the FTSE 100. Compass now down 3.2%, trading 25. If I put my glasses on, 25.70. Diageo down 2.6%.
And that is a to think this stock warned. Was it the start of the year? Was it Q1 that these guys had a warning? Let me just get the quick daily up. Oh, these things, honestly. Let me get, look at that. Diageo has been running along the bottom of that support, and it's straight back down there at that 23.40 level. Does that look like it wants to break lower?
Well, it looks like it needs to hold that level of support. What price is that? That's down £20.
Yeah, 23 is where it has touched. Axel always teaches us to go right down to the bottom. So 22.90. I'm going to put an alert there. Price level 22.90, and then just put chart support. So you can see what I'm doing there in the top right hand corner. This is something I like to do because my memory is going a little bit at my age. So I like to get that there, setting the alert, 22.90, and then I get a ping one random day sitting at lunch.
Well, I'm sure your girlfriend wished you'd had that ping yesterday.
Yeah, exactly. Yeah, I don't put my anniversary in there, but I do put my my stock moves, which actually takes me to the story of Sosnoff in London.
I was just about to say,
please.
He was telling us the story that I think he went shopping with his daughter, and they obviously got in conversation with the cashier, and they were talking about, when was your daughter's birthday? When was your son's birthday? What colour eyes does your wife have? And he's sitting there going, I don't know, green, blue, I'm not sure. But he says he can remember every single trade that he's ever placed, why he bought it, why he sold it, where he got out.
And 100%. The FTSE, the day I joined Credit Suisse in 2004, which was the 8th of April, the FTSE was trading at 4465. Glencore IPO'd 2011 at £5.30. It opened at 5.49, and then we got hit all the way down. Like, it's in that trader's mindset, isn't it?
I think IG was £7.20 when I joined, and we're now £9. Where are we this morning? And it's been down.
You've been here 25 years.
11.
11 years, Luke Moore. That is going some.
£9.41 we are. I'm going to look at the FTSE 250 now. If we go a leg lower in the index, and we've got JD Wetherspoons down 3.4%. So JD Wetherspoons, of course, a huge volume business when it comes to alcohol, beverages, food.
Yeah.
Tariffs if there are more tariffs being put on, one suspect that margin might come under threat. With Diageo and
InBev as well.
And InBev are all taking a bit of a hit. So clearly that consumables sector is taking a bit of a rallying.
Right.
Bit of a rallying.
There's the FTSE 250. You'll see it has had a nice big bounce because that was the budget, obviously, here, and then the bit of weakness tried to recover, and then more weakness, and then it has been back up there for the last, that's a 2-hour chart. You know, it's tried and it got back. We're at this level. You know, what's it going to take for the FTSE 250 to break higher there? What's it going to take for the FTSE 100 to break up through 8,300? It felt so good yesterday. Yeah. It felt we were primed and ready for that Thanksgiving rally. Maybe when the Americans are asleep and when they are busy giving thanks, we will ignore Trump, we'll ignore everything else going on in the world, and we'll just see that investment going into the UK.
Yeah, perhaps. Look, I think with the UK, with the FTSE 100 specifically, you've got to look at what is under the hood. And it's your BPs and your Shells, right? Your big international kind of diversified oil businesses. So the price of the sensitivity of the FTSE 100 to the price of oil is highly correlated, as it is to dollar strength, because a lot of these companies are going to be importing and exporting, and so therefore, whilst they report and are based in the UK, they are making their money often in US dollars. So there's a lot of things that goes on with the FTSE 100.
Just trying to get the weightings up for you, but
it's not necessarily the best way to look at the UK market as a whole. Some people would suggest the FTSE 250 is because you've got much more domestic, you know, UK-based businesses that do business in the UK as opposed to the FTSE 100. But I did see a story where I think it was either Bank of America or JP Morgan suggested that UK banks, as a result of kind of Trump's administration, interest rate changes, and everything that comes with it, would be preferred over European banks. So it's that's going to be one that I've got a client in mind who is a big trader of UK banks. I think I told you the story before. He calls our desk whilst he's on the school run. So he asks, you know, what's going on in the night. So when I get back to my desk, I'm going to have to find out more about that story, Richard, and give you a call. To watch.
There's an interesting piece in the Times this morning, and it's by Alistair Osborne, who has that wonderful name that is made up of the last, two of the last 10 chancellors that we've had. But he makes a really interesting argument here, and it's about the Barclays fine yesterday by the FCA, which was completely correct for FCA to fine them because there was undisclosed payments went to the Qataris. But Alistair Osborne says, just look at the timing of this. It was back in 2008, just after Lehman's collapsed, and it was almost a necessary evil to get the billions, 4.5 billion and 3 billion of funding that Barclays needed not to take government support, right? So we know Lloyd's, horrific, took government support. RBS, you know, disaster, took government support. Taxpayer money. Barclays did everything possible not to have to be rescued. It went to the Qataris and it asked for funding. But there was payments that went back to the Qataris, which the FCA and the SFO were questioning
how
valid they were.
But it was only 40 million, right? It was a very tiny...
Well, that's how much the fine was in the end, yes. So Alistair Osborne he finishes off with... Barclays had the choice of joining the queue for a strings-attached UK bailout or finding a self-help fix. Sure, it cut corners, but its Qatari shenanigans arguably saved both the taxpayer and its shareholders from something far worse. So quite an interesting piece there. And then it goes on, a completely different story. It goes on to talk about ITV and that Dame Caroline McCall was apparently delivering long-term value for shareholders. Alistair Osborne asks how long before we get to that bit of the script, because of course ITV touted by Sky News yesterday as being in play for CVC and a European broadcaster looking at buying ITV. But then he goes through a really interesting breakdown, some of the parts value, and his argument is that ITV Studios is 100% of the valuation, the current market cap of ITV. So you're getting the other parts for free, like I'm a Celebrity.
Or was it ITVX, which is their streaming platform? Did they still have the property on South Bank? Or did they leave that?
I don't know, actually.
I know that there are some renovations going on.
Still there is
kind of
our producer Fred. Oh, we're going to miss him, aren't we?
Oh,
How would we know what was on the South Bank if he wasn't there in my ear all the time?
Well, fortunately, it's on my dog walking route, so I can give you the intel, I can give you the insider scoop, and they've got loads of renovations going on. There's scaffolding up, so whether they're still in there or not, I don't know. If anyone knows, then it'd be worth knowing. But yeah, what else do you buy with ITV? You would be getting the I'm a Celeb that my wife is absolutely addicted to at the moment. What else do they have? Do they have they've got dancing on?
Right, so All 3 Media was sold earlier this year for 1.1 billion. That's roughly half the size of ITV Studios, which has been valued by analysts at 2.3 billion. Now, adjusting for ITV's net debt of 437 million, ITVX and the legacy commercial wing are now largely in, the Times argues, for free.
Well, the current market cap is 2.7 billion.
Which was 10% less before yesterday.
Yeah.
So yeah, you can see why people will be sniffing around if you get an ITVX and the commercial wing.
Yeah. Love Island is another huge asset that you'd be picking up as a result.
Isn't it funny? Like, they cannot come up with anything new. Love Island.
I'm a Celeb.
And what's the one when they spin in the chairs?
The Wheel. No,
when they do the music.
That is a really
Voice.
good show. Oh, The Voice.
The Voice BBC, or is that ITV?
I think it's BBC, but yeah, how many different versions of the same show are you going to get?
The two of us could go on the X Factor, couldn't we?
Well, I know that I'd be getting it. Is it The Voice where they bang the button and they spin around?
That's
I mean, me and you just like this.
Good friend of mine, Danny, that does that from the old McFly. So we were at a wedding together a couple of years ago, and his wife had got so drunk at the wedding she couldn't face driving her car the next day.
Right.
So I had to drive Danny's car back to London, while little Mini Cooper, while they're both in the Porsche, like zooming ahead of me.
Nice.
So
well, he's in the jungle now.
He is in the jungle. That's right. We'll
doing quite well.
Send him a little message, shall we?
Well, he's not going to pick it up, is he?
Well, we'll vote for him then.
Yeah, we'll vote for him. Yeah, there you go.
So
we'll vote for him.
Well, let's see if we can get an interview with Danny on the show.
Yeah.
As soon as he gets
out,
because that'll be Australia time, won't it?
It will be. That'd be perfect.
Right. So what other moves? ThyssenKrupp. How is that one doing? It was touted to be down 1.4. It's down 3.5. This thing was big part of my life back trading the mining and steel sector, but has it ever got out of the teens? Did it ever get up to 20 euros? I'm not sure. Look at that. That is just value destruction. When people argue for investing in European markets,
don't show them that chart.
You look at something like that and you just think, let's have a look at US Steel and see how US Steel's done.
They're cutting 11,000 jobs. Like, that's a lot of people. So they've got, Google says here that in 2020 they had 103,000 employees. And so that's, over 10% of jobs, but specifically in the steel sector, as you just mentioned.
Yeah.
The German economy just cannot catch a break at the moment, can it?
It really cannot. And, sorry to, so there we go. Yeah, okay. US Steel, well, at least it's up, right? So it has had a bid in there.
I was going to say it has had a bid, yeah. You can see that popping up at the start of the year, can't you?
Oh, that's quite considerable, actually. Yeah, so in the last 2 years, it was unchanged up until the bid. Yeah. And now it's gone up, 50%?
And that was Nippon Steel walked in, wasn't it? The Japanese company tried to look at them. I imagine... What's the latest on that story, actually? Did they walk away?
I was just about to ask the same. So here we go. Nippon Steel not to import from overseas.
So the deal is supposedly still on, but they want to get it done before Trump gets in, I would imagine, because it'll be a bit cheaper to do it before than it would to do it afterwards.
Yeah, there we go. Who has pledged to block the deal during his campaign. God, they'll be in a rush then, yeah.
Definitely in a rush. We wouldn't mind being an investment banker working on that deal to try and get your bonus up a little bit.
Do you think we're about to see a flurry of M&A?
I'd be very surprised if we don't, because the last time the pound was around here was the start of the year. maybe kind of springtime that we were looking pretty weak in the run into the election. And you did see, you know, the CVC partners of this world, the kind of private equity guys, take a lot of our businesses private. So I wouldn't be surprised. I'm not going to start calling for ones to, you know, be taken out. But when you've got a UK market, which we all fundamentally believe is cheap and relatively undervalued compared to the rest of the world, and you've got a fire sale on the pound that is now 10% cheaper than it was not too long ago, you start to see a picture where assets become quite attractive to pick up.
Yeah, that's absolutely it. Any and now that the budget's out of the way, right? Rachel Reeves has talked about no more tax rises again this morning or overnight. So you are starting to see the FTSE 250 names. There must be ones in there that are getting looked at. Stocks like JD Sports, right? JD Sports. I don't know what the market cap is. JD Sports market cap, and by no means am I trying to say that this is a takeout target, but I'm just saying. At $5 billion, right? $5 billion sterling market cap. It's relatively bite size for somebody to come along and take with, you know, how many stores will, they've got 80,000 employees.
Yeah. I mean, if you compare that to, I suppose the comparator is a Dick's Sporting Goods or someone like that, like a domestic US listed retailer. They're $17.5 billion.
Right.
So it's barely a drip in the ocean. Although you potentially say that the Frasers of this world that just seem to be trying to consume every single possible UK retail business would potentially be a better suit to someone like that. But yeah, I completely agree. It does beg the question, what is the crown jewel that we have at the moment? And there aren't many.
There's not at all. I mean, when you get press even talking about BP as a potential target, and that's not this morning. You know, please don't take that as a rumor or anything. You know, this was months ago. BP, the Times comment piece said if it doesn't clean up its act or get its act together, then, you know, even a stock like that. So when you're talking about the heavyweights and the top 10 weightings of the FTSE being potential targets. You know, there really are some. Okay, so before we go to Q&A, confirm and send, let's have a quick look at how bad things are this morning once again. Diageo down 3, Compass down 2.5, JD Sports down 2.5.
Actually, that Burberry story
yesterday. Sorry, go on.
Is that Burberry story still running along? Was it Hermes looking at Burberry?
No, I think that was killed off.
Was that killed off?
Yeah.
Was that killed off?
But then they came out with a new strategy update, and the new strategy update's been taken very well.
Good. Okay.
Peugeot down 4 now, Volkswagen down 3, Bayer down 3, and yeah, oof. I mean, this is terrible. Yeah. So I assume that's Stellantis, is it, Peugeot?
No, it's just Stellantis will be its own firm. Have they renamed that? Let's have a quick look.
I'll fix that. BMW down 2, Mercedes down 2.
No, Stellantis is its own thing. Stellantis listed in France is down 5.5.
Down 5.5, Stellantis.
Yeah.
I need to add that one to my watch list. We are working on. We had a question. Well, I'll tell you what. Let's go to confirm and send, and then I'll tell you the answer to that question. So emails flying back and forward, because we got one question in asking about my watch lists. Right now, the one that I use on the show is one that I built myself.
Yep.
And I like it because you can rank it by percentage changes, but also I can take out the stocks that are dull and boring, and so it's not clogged up. Mm-hmm. But a viewer of the show, a friend of the show, was asking, can you get that in the platform? Can we send it? So emails back and forward to Martin Harris. What can we do? So we're looking at getting a show watch list put on the official platform. So you'll be able to look at what we look at and follow along as well if you like those ones to do.
Yeah, great idea. I mean, one of the biggest things that we get as a kind of set of account managers is people looking for ideas, because ultimately that's what it comes down to. It's what is the next idea I can allocate my funds towards?
Yeah.
And having that watch list will be key, because we'll be talking about something on the show, and then you'll be able to go back and have a look at it and trade it on your own account, and that's perfect. That's exactly what we're trying to do and create that community of storytellers and sharing of knowledge. So yeah, absolutely. If they can build that, which I don't think will take them too long, that'll be really, really good.
He's already said he's limited us at 50 names, which is fair.
Yeah.
So I'm thinking we can look at the top 50 traded names by clients, by number of clients trading it, not by volume, not by dollar amount, anything like that.
Yeah.
But the number of clients interested, and that should hopefully reflect what we're looking at. Just in the meantime, we do have upcoming earnings page. Now, this one is worth watching. Aaron Bright, another friend of the show, does keep this one up to date with stocks that are in the news or that are
shortly
of interest. Yeah, so Compass you can see there, Broadcom of course, and where's my one that I noticed as well? Yeah, there was another one there, but I think it must have been taken out.
Yeah.
So yeah, that's on the Discover part of the website.
And I tell you what, if you want to flick into Tasty just quickly, there are some fantastic watch lists on the Tasty side as well. Some really, really good ones. We briefly spoke earlier about...
There we go, got that ready for you.
Yeah, we briefly spoke about the IVR, which is Tasty's way of ranking an individual stock's implied volatility against itself. So is this company volatile or not? Okay, it could be. You would expect a Tesla to be more volatile than a Dick's Sporting Goods.
Yep.
But when ranked against itself, is Tesla more or less volatile than it has been to itself historically?
Previously, yeah.
So if you look on Tasty, and then you can go to Tasty IVR, and I had a great conversation with one of my clients last night.
There we go.
You know, he was trying to find a way to put on iron condors as a defined risk way of selling volatility.
Yeah.
And you know, he was looking at, I think he looked at Google, and the IVR was like 12, super low.
Right.
So actually, we were kind of scratching our head as to why, if I sell this, why am I not making any real money? It's because, well, the IVR was very, very low. So we found this. So this is a list that Tasty will continually update on companies that have got an IV rank, historically ranked high against their own selves, that might be worth looking at if you want to put on a short volatility strategy.
So Nike's up there actually. Nike's at 84.
Nike's up there. That's Oracle,
Moderna,
who have been absolutely scuttling around the bottom at the moment. Adobe. We are giving them feedback. I would like to see the names of the companies on here, as opposed to just tickers. But
yeah, the Americans all know their tickers.
They all know their tickers.
That's the thing, isn't it?
Yeah.
Now, I did actually pay attention to exactly what you were talking about there, and I put a trade on CrowdStrike.
Okay.
Yeah, so we've got a couple of trades to update you on Tasty. Seeing as this is to do with a question of Abercrombie. So I sold the 120 puts. Now that is far away. So, you know, my delta on that is 17. So remember, we talk about selling the 16 delta puts. Well, this is the closest one I could find. So I have sold 2 of the 120 puts, which was traded at 170. So that's $340 of income there for the December expiry if Abercrombie stay above 120. I like the company. I want to buy it at 120 anyway. Results today, that's one to watch. Then CrowdStrike, we've got trading at 363. CrowdStrike, I have sold a strangle at 300 on the put side. Now this is even lower. I'm a bit scared of this move, so I've sold the 10 delta strangle. So that's a 300 put and a 440 call. They of course report numbers today as well. So that was for a total income of $5.18. $5.18 there.
And following that mantra of trying to sell something as close to kind of 45 days to capture that degrade in volatility. Which is the Tasty kind of mantra.
Exactly it. Now, I think we've got a question for you from Supersonic 16. That is a good name. Supersonic 16. When a stock goes ex-dividend, the share price drops to reflect the payment. On dividend payment day, do you see a share price pickup as dividends are reinvested? Great question.
Great question.
What percentage are usually reinvested?
I'd love to know.
That is one for us to take away.
Yeah, definitely.
Because I always think that you see, well, in my experience, some of the time you see a bump into the ex-dividend date, right? So beforehand, especially on the big dividend payers, primarily just because people realize that there's, Vodafone, for example, was going to drop from 69 pence to 67. And suddenly they're thinking, well, Vodafone at 67, on a valuation, that's too cheap.
Yeah.
So it was bought into it. And sometimes income funds also like a big chunky dividend because it looks after their income for that month. So you see big buyers going into it. However, I've never looked at what happens afterwards.
But you get, so one of the ways that you can allocate towards big dividend payers is via a fund. And so if you look at ETFs will often be classified as an accumulating ETF or a distributing ETF. Have you seen that? It will say ACC or it will say DIST. And what that says is the dividends that the constituent stocks within that ETF receives, so if it pays out a dividend, the ETF either then uses the dividend cash to just completely reinvest back into new units of the stock, in which case you pick up the growth, or it distributes to you on a quarterly, weekly, or daily, depending on what type of ETF you've got.
Yeah.
Different tax treatments for each one, of course, because if you're taking the dividend income as income, you'll have to pay tax on the income, or keep it in as capital gains and grow it. There's a different treatment between the gains and the income.
Yeah.
Yeah.
And it's interesting as well, from going back to the question, the payment date is actually quite long after, isn't it? Payment date can be anything from a month to 3 months later.
Yeah, actually, that's a really good point, because when you're trading on our OTC business, so if you're trading a CFD or a spread bet, we actually adjust your account by the dividend on the ex-dividend date.
Straight away.
Straight away. It comes as cash before 8 o'clock in the morning. If it's a UK stock, you're going to get it straight away. And that becomes quite interesting, because then you can use the cash much earlier to reinvest back into the stock if you would like to. In the real world, the physical equity space, you have to wait to the payday, which is usually a month or so afterwards.
So in the stocks and shares account?
Correct, in a stocks and shares account, yeah.
And do people know, is there like some kind of thing on there that says you are due a dividend income?
You will...
Or do you get an email?
No, it will come through in the stock news, and you'll get it on your statement overnight. So we will email you a statement each evening that show all of the different cash payments to or from your account, and you'll see it on there. Yeah.
Got you.
Yeah.
Great. Excellent. Right, let's go to the official confirming question. Confirm and send question 1, please. How do I determine the right position size for a trade, Luke Moore?
There are probably about 1 million ways to answer this question.
Yeah, true.
1 million ways to answer this question. My approach is, and I try and take a risk-based approach to it, because I know that I've had times when I've placed trades that are, far too big or far too small, and I try to work based on my risk. So I will always say, okay, I'm going to allocate 3% of my account to this particular trade, or 2% of my account, and then work backwards from your stop. Would be the way that I would look at it.
Got you. So then you know what your loss.
You know what your loss potential is going to be, and then I would say, okay, so if I'm risking 3% of an account that is worth £10,000, therefore it's a £300 risk on the trade, and I'm going to be looking to go long the market, whatever it might be. Then I try and take the decision to say, well, I'm buying the market at this price because of X, or I'm selling it because of Y.
Yep.
Where am I wrong? So if I've got this trade idea and I'm buying the market because I think that it's going to break through a level, right? What was the stock earlier that we looked at that had broken above and was finding support? Was it Melrose? So if you want to buy Melrose on the breakout, but you then look at the market.
That was it, yeah, Melrose.
Yeah, the kind of swing low. When did it previously make a low? That's going to be where my stop is. Whatever that distance is between your entry and your theoretical stop.
Should we build it?
Yeah, let's build it.
Yeah. Okay, so this was Melrose. We're going to look at. I'm a very visual person.
Yeah. Yeah.
Much better to see what we're talking about. So I am looking therefore to buy. Let's say 100 shares, well, 1,000 shares.
Well, no, but this is the thing, right? We've got to.
You don't
we're
know
waiting.
first.
We don't know.
Yeah.
So if you zoom in, right? So where is, let's say that yearly, no, that little cluster of candles that we saw over the last week or so. Where is that low in here?
The low is probably 521.
No, come down a little bit more. We saw, keep coming, keep coming, keep coming, keep coming. There. Let's see around here.
Right, so £5.
quid.
Yeah, £5.
So
right.
£5 is going to be our theoretical stop. And you would say, because I've seen some support around that level, there was some wicks, so therefore £5 is our theoretical stop. It's now 563. So our stop distance is going to be 63. Okay?
Great, okay, I put 64. 63, there we go.
Now,
right,
if
now
we
we
was-
get that beautiful line up there. So
Yeah.
there's our stop.
So if we were saying that this is a £10,000 account and we want to risk 3%, we need a calculator because we want to find out how much money we would.
Don't you worry, I can sort that out for you. So let's go 450 shares would be a loss of 283.
Okay, dial it up to 500. Would that get us closer?
59, 467, oh, 479, £301.
Perfect. This is how I would set a trade up. So on my £10,000 account, what this is basically saying, I can lose 30 trades in a row
Yes.
before my account blows up.
Oof. I would have a word with you before 30 trades losing in a row, but yeah.
I would. But then I would also set up, if I've lost, say, 5 in a row, I'm going to reduce that from £300 risk to £150 risk. So that actually my chances of ruin become reduced. And this is something that Axel has kind of taught me along the way, is that the gambler's way to do it would be to size up, but actually your edge just completely erodes because you're not acting, in line with your risk parameters.
Exactly.
So sizing down, it might be less exciting. You might be making or losing less, but actually your road to ruin is a lot less likely because you're reducing your risk every time.
And while we're at it, where would you set your take profit target?
So I'd be,
And
if
risk
I'm
reward.
risking 300, I would want to make at least twice that. So I'd be wanting to make 600 on the trade. So it'd be a 2-to-1 risk reward for me. And look at that, quite nicely. If you put 2-to-1, it takes you above that recent high. So that would be a trade setup.
So I'd be tempted to come down because it's like Bitcoin. People that went in at 100,000 to sell Bitcoin, I mean, how greedy do you have to be not to set it at 99,000?
Yeah.
And now you would have sold at 99,000 and you could come back in and buy it at 93 if you wanted to.
Yeah.
But no, just, you got to think about these things, that the queue was out the door to sell Bitcoin at 100,000.
Yeah, the Bitcoin wall.
And you could have jumped straight in front of it by going in at 99,000. You would have been all done. You would have been off with producer Fred to France to enjoy wine, baguettes, cheese.
I can hear him laughing in the background.
Yeah.
But you're right though. So if you want to carry on working that trade through, and I've just caught a glance of myself on the screen, this bloody pear's back up again. Something about Mary.
Your wife will be on.
Yeah, she's going to text me again. So if you're reducing that limit, you're going to kind of tighten up your take profit. You should then, in theory, also change your stop to keep the position size in the same. Or you run through the same exercise again and you just say, what now? If I'm going to keep a 2-to-1 risk reward, what is my optimal size to continue to risk 300 if I'm tightening up my take profit?
That's great. I like that a lot. Okay, so that is one way to determine the right position for a size. Now, there are 4 opportunities a year in my books, in my experience, 4 opportunities a year when the odds are in your favor and you just see the conviction, right? And you see the opportunity, even if it's short term, then I would feel more comfortable, going up to maybe twice the size or 3 times the size if it's not overnight. Because yesterday I felt conviction that this Besant appointment as Treasury Secretary was a real opportunity to buy bonds, to buy the euro, to buy the German autos. And it looked fantastic over 4 hours, 5 hours, and I took some profit, took some money off the table, and thank goodness I did, because if I'd left it overnight, that overnight risk is always what
would have just got you.
Hammers you.
Yeah, that's it. Well, Bill Ackman quite famously said fairly recently that to make proper money, you need to concentrate. So you have to buy your winners. And he was saying diversification is an excuse, right? And this is Bill Ackman's words, not mine. But he was basically saying if you want to outperform the market, you need to be more concentrated than the market and pick better stocks. There's 500 shares in the S&P 500. Why buy the rest of them when you only want to pick the good ones.
Yeah.
So I do agree. But I think when you're looking at a trading pot, and I suppose it depends on whether you're a price action based trader or whether you're a fundamental trader. If I'm trading purely based on price action, and I know very little about Melrose, but if I'm going to be purely based on numbers and I go, I've got a 2-to-1 shot to try and make money on this breakout, if it squats back into its previous area of resistance, yeah, I'm wrong. But if it carries on, then I might be right. It would be a different way to do it.
And that is exactly my trade on HSBC at the moment. So I've got that long for a potential breakout. You can see, right, where are we? So on the chart there, you can see purchase number 1 was at 726. Purchase number 2, I thought we were going to get a breakout that day. Look at it there. I got all excited. I thought we were going higher and it failed. So I should really have a stop somewhere down here at 713, shouldn't I?
Yeah.
Or maybe just below that.
Maybe just below that, yeah, because the same can work in the inverse. That's where all the buyers are sat. So you don't want to be jumping the queue for buyers to get stopped out before that. You want to give it a bit of space.
Okay, right. I'm going to be diligent and put in a stop at 708 on my HSBC. We'll do that right here before we're going to leave. And right, 708 HSBC. There we go. Adding stop 708, which means the limit will be double that, which is 23 pence away. 46 pence is 777.
Perfect. There you go. Boom. Yeah, but as I said, there are tons of different ways to define trade size. We looked at it there just kind of very fundamentally, just looking at where some previous resistance is. I know clients that will use an indicator called average true range to try and define their size. So if the ATR, which roughly shows you what the volatility is on a look back period for 14 days, 14 candles, depending how you set it up.
Okay.
So that if there is a move outside of its historical move, then they want to get stopped out. So then they'll use that as a way to set their stops.
Okay.
Another one that we were talking about, I met some clients at the weekend, we were talking about using Tasty's expected move as a way to set stops and limits. And again, then you work through that same process of, okay, if I'm working 3% of my account as risk, this is where my stop is going to be. How much risk am I going to be then putting on? Okay, £100, £300, whatever it might be, all depending on your portfolio. And then you work that conversations backwards. But I'm a huge fan of, we can't control any of this stuff. We don't know where the price is going to go. You know, you were quite right.
That was Sosnov's point as well.
How can you control that Trump isn't going to, jump onto truth media and start to, pull some strings again? So you have to defend yourself against this. And stops are such a key way to do that. Oh. Position sizing is another way, because if you're too exposed and without having this conversation with yourself and being honest to it, because you can have these conversations and go, this is one of my 4 times a year. I've got huge conviction. Yeah. I'm going to go for it.
Yeah. The other, if we're trading 4 times a day, did Angeline just knock on the door, or was that?
No, I think that was me.
Okay, can we? Sorry, Angeline's dying to get in here. Can we just put the Angeline on hold music on for a little bit, please? We're going to find the on hold music. We're just going to put her on hold for a second while we finish this. Okay. There we go. That's for you, Ange.
Angeline Ong. Oh, we also said off camera was AO World. It's Angeline Ong's World. Oh, did we say that? No, we said that on camera.
So yeah, coming up are Tom and Ange. Luke Moore, Ange, you're here. It's been fantastic having you on. Yeah, that's going to have to go.
I'm going to have a word with Harps. If you ever want to go and get your hair cut, Odyssey Male Grooming up in Shoreditch, go see Harps. Tell her I sent you.
Here we go.
But you've got to get this sorted tomorrow, so I'll come see you tomorrow.
Harps, I'll be there on Friday.
Exactly.
Good stuff. Right, we're going to take a quick 5 minutes. We're back with Wolstenholme and Ong.
Have a good day.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Trading the news is an essential skill for all traders. Major news announcements can often cause large price movements, particularly in Forex markets. So, here are 5 key pointers to help you try and make the most of those moves. 1. Do your research. Know the times and dates of important events. Use an economic calendar, for example, the one on IG.com. It's a vital tool to help you plan ahead. There are many announcements on any given day, and it's essential you know which will affect the assets you're trading. For a Forex trader, generally any event impacting the US dollar is important. Events like non-farm payrolls, Federal Reserve minutes, and GDP. If trading shares, look out for company earnings, dividend payments, and stock splits. 2. Check what the market expectations are for the event. Look at a chart of what happened last time. How did the market react? Was the data better or worse than expected? Did earnings beat or miss estimates? Use what happened in the past to inform your future trades. 3. Study related news and events. What else could impact the market in the wake of the announcement? Take crude oil as an example. US inventories are due on Wednesday. If there's an oversupply, the price should drop. But say OPEC ministers are meeting Thursday. If they reduce output, the price could rise. So, it's essential to look at the overall picture and not take each event in isolation. 4. Put a strategy in place. Know what levels you want to buy or sell at, and where to put your stop losses. This will help you to have the courage of your convictions and avoid knee-jerk reactions. And finally 5, learn when to fade the news. Here's an example. The CEO of Company X announces he's leaving. The stock falls, but you believe the company's fundamentals are still sound, and the market is overreacting. So you hold your position. If you're right, and the price rises, you could profit. Of course, if you're wrong, and the price continues to drop, you'd make a loss. Remember, these are all just guidelines. While trading the news can be exciting, it is also risky. Unexpected results can lead to high volatility in the market. So, make sure you're well prepared, and always have a solid trading plan.
Hello, trader friends! You clean kittens! I'm saying that because Fred has said no more dirty dogs, and so I'm going to clean kittens.
Yeah, a bit inappropriate.
Not for, it's already 8:47. We're almost at all sessions. I think, you know, we're almost at watershed. Speaking of which, that's why Tom W. is here with us.
Hello.
Before we get to these magic buttons, everyone's like, what are these magic buttons? It's so cool. You'll find it in a second. But we have to get them across your current housing property ladder situation.
Yes. Yeah, moving in on Friday.
Ah, Friday you have a date.
Friday we have a date.
Keys in hand.
I think we pick them up on the day, but I've got a van sorted.
Are you driving the van?
I'm driving the van.
Oh my God.
I phoned up the company and I was like, hi, can I have one of those big vans, you know, with the cool, you know, up and down things on the back?
The hydraulic seat?
The geezer on the phone was like, you want a Luton van with a tail lift? And I was like, yeah, please. And he's like, right, yeah, I'll book you in. So I've got one of those up and down on the back.
Okay.
Yeah, so we're all sorted pretty much.
And is that going to be enough? Because, you know, you look like the kind of man that has a lot of stuff.
I've got nothing. We've got absolutely nothing. I've got, to my name, I have 2 bedside tables.
that's pretty much the extent of.
I mean, I know you got fancy Rafa gear, so all your bicycles, you look
I've got
some
one Rafa top,
multiple
2 ba-
bicycles. No,
Got to get 2 bikes in. That's true.
yeah, 2 bikes in.
Yeah.
That's just for you, right?
That's just for me. Yeah, you got to have 2 bikes.
How about your beautiful wife? I've met her before. It was a crazy moment, Trader Friends. I bumped into him, his wife, and I had Frank Caberna's other half. I felt like it's supposed to be the weekend, but I'm back at work again. What's happening?
Yeah, because you were following me. Yeah.
I wasn't following you. You were following me. I actually live there.
Yeah, true. That's true.
Does she have a lot of stuff? I mean, like, I
No,
think
we
you're gonna
haven't-
need more than one van.
We've been renters for so many
I
years.
think you're underestimating this.
No, it's a big van, a
Okay.
Luton van,
Ooh.
whatever that is.
So Friday, have you started scouting, you know, places to, like, have you already bought stuff that's about to be delivered? No?
No, and it's a minefield, isn't it?
It is.
Trying to decide all this stuff. There's so much stuff available. You know, no. We haven't done it. We're going to have to be sitting around on the floor in an empty house
Having pizza.
having pizza off
Nice.
the floor. Is what we're going to be doing.
Now, speaking of magic vans and magic buttons,
Yeah.
you've got some magic buttons to
Good
show
segue,
us
yeah.
today. I actually use the one click. Let's have a look at the one click first, because a lot of clients are asking, where is this one click button?
Sure. Yeah, we can absolutely do. We can look at a few things. If we bring up my screen, so we've got top right here, up next to where it shows your account, we have this feature called one click for the more adventurous of you. So if you want to apply one click, you'll be asked to read this, which essentially says that you will only require one press of the button to close a position when you're looking at it in a list. So if we enable one-click dealing here, what we'll find is, if we say go to positions, we'll see that the close buttons are now all illuminated green. And if I were to click one of these, it would then close it down immediately. Whereas previously, if I turn this back off again, when we're looking at our positions, I can see here, if I click close, it'll ask me again.
Yeah.
And I can adjust it slightly. It'll ask me again if I want to close it or not. One click, straight in.
Yeah.
Make sense?
Makes sense. What I like about one click too is that when you're on the buying side, one of the PCMs is telling me you can also set it up. So if you always traded gold, for example, and I like trading gold, you can have one click and you just have the same size every single time. Is that correct?
If you want the same size every time, slightly different setting, but we can look at that.
Cool.
So
that's amazing, because we had some questions from a lot of our viewers on our YouTube Trade Live with IG, but also thank you all of you that emailed in. Peter J was one of them, asking whether we had this function. I messaged him earlier, and I think it was Andrew as well that messaged us saying, can you show us this function? So here you are, people.
okay.
Tom W is going to drive you through this like he's going to drive his white van this Friday.
Hopefully this goes better than the white van will. If we bring up the screen, so here's our home screen. Bottom left of our sidebar on the left-hand side, we have settings, and we've got 2 options here. So at the top here, save deal size and save stops and limits. So if you turn these on, if you turn on save deal size, what you'll see is that your last deal size and currency for that particular market will be remembered. So when you go, if you trade FTSE and you always do it in £5 a point, next time you go to FTSE, that will be pre-filled for you.
Nice.
Nice and simple. That makes sense, doesn't it?
Yep.
And the other one, very similar, is save stops and limits. So if you apply this, again, this is for, it remembers it per market. So if you're always having your stop 10 points away and you're always having a limit 20 points away, for example, this will remember that for that market. So if that's what you typically do on, say, FTSE, that's what it'll do for you every single time, save you some time. Yeah, those are your save features.
Sam Peach from the PCM desk also said what's really cool about the save stops and limits, which I'm going to use from now on, it's very handy, is that if you only trade, for example, 3 key instruments, it will also remember your stops and limits for those. So if you traded DAX, FTSE, and US 500, it would remember the specific stops and limits for those 3. Is that correct? I haven't tested this out.
Yes, so it remembers it for that market.
Yes.
So it won't just apply it for all markets.
Yes.
But if the last time you traded, let's say, what did you say? Wall Street, did you say?
Yeah.
Let's-
US 500. So
the last time you
S&P.
traded US 500, if your stop was 20 points away and your limit was 40 points away, the next time you go to Wall Street, it will be the same. But then if you went to a different market, it wouldn't be, because it does it per market.
Is it clever enough, Tom, to remember the average stop and limit you had for that particular instrument, or does it just take the last?
It's just the last.
Ah, okay.
Yeah, it's the last, very last one.
Nice.
The last stop and limit you did on that market will be applied.
Thank you. So I like this because I like putting legs on trades. So like, you know, yesterday and the day before I had like 6 legs on gold, and I like clipping them off, you know, as I go along, clear out the losing trades, and magnify the ones that are up money. So this is really cool.
And when you close them, you could always use the one click
Yeah.
if you're brave enough.
If I'm brave enough.
Trust yourself.
I have to make sure though that I'm not sort of like gin and tonic in hand, because I'm likely to like hit the wrong
Well,
one.
if you spill your gin and tonic on the keyboard. Also, we'd advise against consuming alcohol and operating your trading account, obviously, but clearly you're advanced beer, you could spill it and you could close everything. So
That's true. This is true.
we actually haven't put that warning in. Maybe that's something we should add. You know,
At the bottom.
just only use one click if you're not drinking.
Yeah. Do not operate heavy machinery.
Exactly.
Either. Yeah. That's a good one. That's a good one. There's another one that I have never used before, and many of the PCMs, and then you talked about it the other day, and I thought this is great because I've never used signals.
Signals, yeah.
Where do you find this? The trading signals.
Okay, so we bring up the platform again. What we can do is, so down that left-hand bar, right around where you see we have things that we've talked about a lot in the past, tip ranks, economic calendar. You also have signals. Now, what signals is this surfaces analysis from 2 companies. And this is chart pattern analysis from AutoChartist, and this is recommendations from PIA firsts. So you can see for each of the signals what the source is. And there are just 2. There are 2 that we surface. And this is showing the duration, it's showing the direction, and it's showing when this signal was generated. And if we pick one, so let's say if we look at dollar yen, what this will show is this analysis from, in this particular case, AutoChartist. And it will show you that according to their analysis, they have an 81% confidence to buy. Now, it will also provide you with the information that they've come up with. So, for example, the stop, the entry, and the limit. So they'll add a bit of a description saying approaching resistance level of 15449 identified at 26th of November at 7:30. So it shows you where it would enter, what the stop and what the limit would be. And if you click copy to order,
Nice.
that will apply the entry level that they have come up with. It'll apply the stop and it'll apply the limit. And we can see that.
I like that from mine, it's actually punched in half, 50 pence per point. Presumably, it's remembered what I last used to trade dollar yen. Is that right? Whereas yours it's blank.
Mine's blank because I haven't had that setting on.
Right.
And then traded dollar yen, which is why it hasn't auto-filled it for me.
Got it.
So I've copied this AutoChartist analysis onto the deal ticket by doing copy to order. And yeah, you're right. The next thing I would have to do is I would have to apply my size of, say, half a pound a point or a pound a point. And I'm using here the price level, the stop and the limit that has come from this AutoChartist analysis.
Okay, great. So I like back testing. Rich doesn't believe in back testing.
I think he said he hates it. in
Yeah,
fact.
yeah, he hates it.
Strong opinion.
Sahil loves it. Sahil is like the data guy for Trade Live with IG. I respect all views as long as it's useful. How do we back test this? Can we?
I don't think you could well, I'm not aware of a way you could back test this, but what you could do, I think, is you could set up a demo account and you could test out the signals feature to see if it's something you're on board with.
Okay. Now, I really like duration as well. I mean, I can't stand it when someone talks about a trade and a thesis and a story, and then they don't talk about duration, because duration is sometimes everything.
Yeah.
How do I know, looking at the auto charters and the PIA first,
Yeah.
how do I know what the duration, and of course when they came up with this theory, right? When they came up with this trade analysis.
Sure. If we go back to the platform, we can see it shows you against each signal, it shows a duration of either intraday or short term.
Right, right, there you go. Trader friends, is on your right. Yeah.
Intraday being you would open and close that trade during trading hours today. Short term, I mean, admittedly is a bit vague, but ultimately that's potentially more than intraday. But it's still quite loose. But you've got the stop and the limit that's coming with that signal. And you can see when it was published, and you can see when it was updated. So if this piece of analysis was published at 8:13, they might update it later. So I wonder if we can see one where the times are different. So,
Down at the bottom, there's high-grade copper, 746.
but it looks like these have all been published this morning, and they haven't been updated since. But you will sometimes see that a signal will be published, and later in the day it will be updated, and you can see that you had the original signal, but it's been updated for that market.
Interesting.
Which you'll see. It's quite early at the moment, but later on that's something that you might see. And yeah, and you've got the two different sources to bear in mind. Two different companies providing different analysis to test out, and you'll see that each of them, as you switch between the markets. So the auto chartist, you'll notice that the description that goes with it, they're all quite similar. It says, it talks about approaching support level.
I quite like the PFS one. I quite like they're more detailed. Some of them go as far as to tell you the reasoning behind that theory. Like I was in high-grade copper. Have you seen that one? It's
so if we look at high-grade copper,
early pessimism likely to lead to losses, although extended attempts lower are expected to fail. So for someone you know, that looks at charts from a technician's point of view, that's really useful.
Yeah, and they have slightly different approaches, and you can read their approaches. I've got a page here. This is the IG page about trading signals. So if you were to Google IG trading signals, you'd find this very easily. But this talks a little bit about the two companies. And as you can see, they have different approaches. So AutoChartist is a market leader in automated technical analysis. You can see that PIA First is a strategy service from a group of professionals. So they have slightly different approaches, which you can read about. But yes, that ultimately means that when you look at some of the signals, you'll see, yes, PIA First has a bit more of a description. It's a bit more of a kind of a human description of what they're seeing, rather than AutoChartist, which is kind of, we've seen a support level. Here is what it is. Yeah.
Also, trader friends, it's important to note, and loads of them saying, love what you're showing them, Tom, because a lot of people don't, I didn't know this was here, that AutoChartist and PFS, you can get some of this granular stuff on their websites, but it's not set out in such a convenient way.
Yeah, I mean, if you like the analysis, I guess the advantage here is that if we just bring up the platform again, the advantage really is that if you were to look at the website and then apply it, you'd have to copy the support level, copy the entry level, copy the stop, copy the limit. The easy thing is, if you like the analysis, you can press copy to order, and it will just put in those.
Monkey Man says he likes gold. He's looking to trade gold. So shall we show him? There's one here that's
Have we got gold here?
PIA First, and they've got spot golds down at the bottom, and it's got sell signal for spot gold. Monkey Man, this was updated at 7:13 this morning.
I can't find it, you know.
Oh. It's there you go. You've just gone past it. To go up a bit. You were scrolling too quickly.
There we go.
Yeah.
See, I'm too quick. All right, spot gold. Here we go.
Yeah, there we are. And so, Monkey Man, this was updated. Well, the original published time was 7:13, and they're looking to sell at 2663. Just underlining that this is PIA First's thesis, not Angeline's. I will get you that in a moment once we have a break. But it does say right at the bottom that why they have that call. They're looking at the Marabuzo, which, interestingly enough, do you know what that means, that candle, that
I
name
don't.
for the candle?
No.
It loosely means bold man.
Okay.
You could write song and prose.
Has it got a nice kind of dome top to it? Is that why?
Yeah, and no like lines.
Oh, okay. Oh, I see.
And
Nice
there's
and
also
smooth.
a pregnant harami, and then engulfing, yeah, that loads. You could write a whole story about candles, just using candle names. But what I like about this is it tells you exactly where they see the selling continue, where the pullback levels were. So this is great for educational purposes too.
Yeah.
From a technical basis point of view. Helps you draw those yellow lines, or I think Adam Deleuze, who is one of our premium clients who watches our show, says Angie's golden lines.
Oh, yeah?
Which there are many.
Sounds like a compliment.
Speaking of which, is there any other way of using this? I mean, I like the charts because it also shows you what they're looking at. Have you seen any other way of using this that will, I guess one good way is if you copy to order. So let's say I like that gold trade, I copy to order.
Yeah.
You can then tweak. It self-populates. So showing you my screen now, people. Monkey Man, this is for you here. So spot gold, I've clicked copy to order on the left-hand side. It has auto-populated the deal ticket or the order ticket. And what I like about this too is not only auto-populated, but it clearly, you know, in the red tells you that this is a short, gives you a number of points away, and you can actually very easily change that to whatever you wish, right? Wherever you want your stops to be. You can also take a look at your good till order. So this is a really easy way of populating your deal ticket. One other thing though, I've noticed this third tab down here, notional value, right?
Yeah.
See the notional value of your deal in the ticket. Do you ever use this tab?
Oh, every time. All the time. I always have that on. Because obviously when you're trading with margin, you can see what money you're putting down for your trade, but really seeing the notional size and understanding the total exposure you're having is something I certainly would want to know. So yeah, I always have that. I always have that switched on.
Nice.
I think that's, yeah, I always.
So coming up to break now, being told that we have to wrap up soon, but I just want to make sure that you're aware. Everyone that's watching us this morning said, Ange, tell us what Tom's address and what time to meet for the party, yeah?
I mean, we've got to have the party before the furniture arrives, don't we? Because we can absolutely wreck the place.
Yeah, don't
and it won't really matter.
Don't even try to clean up. We just arrive.
Yeah.
With
I'll make.
He's inspiring me.
I'll make a Facebook event like the good old days.
Oh yeah.
And we can have like thousands of people turn up.
Yeah, and they just say I'm a friend of Monkey Man's, or I know Ange, or I know Rich, and we'll just arrive with bottles and. I'm
gonna have to get bouncers. I'll get some bouncers. Sounds like it'll be fine.
Cool. We'll ping that to you. He's looking very nervous here, but good to have you guys on. Hope those really cool buttons that we showed you earlier on that Tom talked us through. Thank you so much for doing that for us.
You're very welcome.
We're going to get this clipped up and sent out to our PCMs. And we'll see you back on Thursday with more of Tom's magic buttons.
See you soon.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Wake up and smell the coffee with Jack McGuire live from the trade desk. Jack, thank you so much for joining us.
No problem. Good morning.
Morning. I was so embarrassed when you caught me out last night. And when you messaged me at 9:30, was it 9:30 last night?
I think it was about 9:30, yeah.
And I was frustrated. And I was trading gold and oil, and I thought when you messaged me back going, what are you doing still up? And I was like, oh my God, Jack now truly knows I have no life.
Yeah, you gave me a shock when you replied, I'm not going to lie. Did not expect a Teams message at 9:30 at night. Yeah.
I wanted to, my husband's next to me as I was doing that. I wanted to take a photo and send it to him, but he was not looking best pleased. He's like, who are you messaging at 9:30? Who's Jack? But I saw your message pop up. I was like putting my stops and loss limits in. I was like, oh, this is so nice. And my take profits. I was like, so nice that someone else is up and not watching trash TV.
Yeah, you've got people with you. Don't worry. There's a few of us hidden around.
Were you in the office or were you at home when you were messaging me?
I was working from home, so not too sad. At least when I finished, I could chill out, have a bit of food or something. But yeah. It wasn't too busy of a night, so
nice.
meshing around and working from home is not too bad.
Nice. Well, you guys are my heroes. You don't know it just yet, but you all have. I've got like a first call list. Those times if I ever need someone to like pick up the phone, I know you guys are awake. So speaking of, speaking of lots of changes in the market, especially overnight. What have you seen in terms of flows and our client interest after the Besant bump? I've heard at least 5 pronunciations.
Yeah, I'm still trying to figure out how to pronounce it as well, so I'm with you there. I think we got a little bit of overnight business. It was sort of the Monday open, so a few of the markets that we do hadn't come online yet, so some of our daily options on maybe FTSE and the European side of things. So we got a little bit of business on the US, possibly not as much as you'd expect. And then as we went through the day, it kind of changed the story a little bit because of other news coming out. But yeah, it's an interesting appointment. I think the market likes it.
Yeah,
I think potentially the news overnight of Trump trying to impose tariffs immediately probably reverts back on that. I think people were assuming that Bassett would come in and be a bit of a sensible head in the room and understand the impact of tariffs and sort of the negative connotations attached to them. But then if Trump's making these type of statements on social media and he's not even in his presidency yet, it's a tricky situation. I think it's going to be a bumpy ride. But the market's clearly looking at people like him for a bit of hope that there is going to be some managed approach to things. It's not just going to be punitive tariffs constantly, and a lot of shocks. Yeah.
And I guess this also holds. Do you think it, Jack? Do you think it's partly because he's a respected hedge fund manager, right? And the fact that everyone thinks that perhaps Besant, if that's how you say his name, is going to have a calm, cool head and, be a bit more sort of restrained, if you like, before putting any sort of tariffs on?
I think he's, from what I've been reading, it seems like he's going to have a little bit more of a managed approach. So he's not going to implement tariffs overnight. There'll be a bit more of a idea and strategy behind them and use them as a negotiating tool rather than doing these in such a punitive way. So Trump overnight saying that he's going to put 10% extra tariffs on China because of drug imports and things like these. It's a little bit, it just doesn't seem like a political move and a good economic move, if that makes sense. You'd probably want someone who's in there trying to leverage the fact that America has this trade power and use it to their economic benefit rather than using it for political reasons, if that makes sense.
Totally. So I'm just taking a look at my charts now. I'm taking a look at one that I have traded recently, but hit a pause button. So adding the dollar chart here, we're seeing that this has continued to rise. This is a US dollar basket that I'm looking at, and for some reason it won't let me add to workspace. Maybe all the signals, the thing that I was running through with Tom earlier on has kind of messed up but you can see it on my chart here on my right. Do you think that because of this appointment, we are likely to see the dollar strengthen further? I know it already strengthened due to, Trump's expected pro-inflationary policies, but do you think perhaps, there might be further strengthening now that Besant is in place?
Yeah, I think so. It's going to be a bit of a bumpy ride. I know the market's priced in quite a lot of this at the moment. You've seen the dollar strengthening on predictions of a Trump win, and then now tariffs being sort of proposed or potentially implemented on his first day. I think we're probably going to see more of this. There's been nothing announced about Europe at the moment, but European indices have come off overnight. There's clearly an expectation there that tariffs are going to be implemented. So I think the more and more you get down the line and find out what Trump's real plans are in that sense, you're just going to get further strengthening with the dollar. I think that's definitely a trend that's going to continue for the short term at least.
Okay, and in the short term, what are we looking at till year end, or?
I mean, potentially further than that. Trump will come in January, and from that point on, you're going to be able to see what he's actually going to implement rather than what he talks about on Truth Social. It's clearly a good indicator, and he's got a lot of power with the size of his win in the election to implement these things. But yeah, you're not going to get the concrete picture. It's going to be a lot of speculation up until that point, until Trump comes in. So I think the first 3 to 6 months of his presidency, you're going to see what is actually going to be put in place.
And I am going to get a huge pot of popcorn, and I'm going to actually be at my friend's party. She's from Philadelphia, and we're going to watch it. We're going to watch it together, just out of curiosity more than anything else, because really it's down to those policies and what he lays out, right, for the coming year. With no ideological thing in place, but we feel, well, I studied in America, and she was originally from Philadelphia, so we have a great interest in this. It's definitely been feeding into volatility. I mean, this week as well, we've got FOMC minutes, I believe.
Yeah, FOMC minutes tonight. A bit of a strange one, to be honest. We don't get too many surprises with these anymore. It seems like it's all speculated, and through various Fed speakers throughout the month, you get a clear picture of what's expected. I think tonight's going to be more or less the same. US vols pretty low, like relative to other ones we've had in the past. This is pretty low, so there's some decent value there. And the market's clearly not expecting any shocks or any move. We've had this change of policy because of these inflationary things that Trump is probably going to implement in his presidency. The outlook on inflation has changed over the course of 2025. So I think we're probably going to see more restrictive policy for longer. Whether that changes tonight and you get a move, it doesn't seem likely, but that's what we're going to be looking out for, I think.
Do you think we might get a particular mood music from the FOMC about the cut of a likelihood, so the reduction of the likelihood of a cut in December?
I think so. I've just this morning I've seen one of the Fed speakers saying that it's still likely there could be a cut, but again, with the forecast over the next year trimming down, I think it was only 2 or 3 weeks ago now, we were expecting 4 cuts by the time we got to the middle of 2025. That reduced down to 2. They could probably go ahead with a cut in December, but it's then the outlook from December onwards. Yeah, it's a little bit of an unclear picture, but the rate expectations have definitely shifted up here. And it's probably interesting to note that with the shift up in expectations on the US, we don't expect that shift up in Europe, where they're fighting sluggish growth. There's a lot more of an incentive to cut rates faster. So we're probably going to have a little bit of a divergence there between European and US monetary policy. Could open up a little bit of an interesting space in FX. I think there's going to be a few trends over the next month that if you get in early or you call these, it's going to be very lucrative trade.
I like that, Jack. I like interest rate differentials and trading that. I think you're right too. I have this base case scenario that inflation is going to rise in the US, and therefore the dollar is going to be strong. But then the pound will remain weak, and certainly the euro. What's interesting too, Jack, and for those of you that trade interest rate differentials, is that similar to the US, even if you look at UK interest rate futures, it has been coming back down. They have been going from maybe 3 to 4 cuts next year, now to 2 to 3 cuts here from the Bank of England. So there is that reduction as well. The question is whether the reduction is going to be faster than the US.
It's an interesting one. I think you'd probably expect it to be faster in the UK, just because of the state of the economy. It looks like the US has managed to keep a pretty strong economy throughout this whole sort of restrictive policy period that we've had. I think if they can continue that, and Trump's policies coming in are going to be inflationary, but a cut in taxes, reduced regulation, you'd expect that's going to prop up growth for longer. The UK doesn't seem to have that equivalent. We're going to have a shift in that policy to manage our growth and keep labour markets functioning properly. I think Europe's going to be the one where the divergence opens up the most, because their inflation seems on course at the moment to go below the target rate. So they've got a lot more room to maneuver on the downside to help fight that struggling Eurozone growth.
Nice. I'm gonna look at that after the show, Jack. Now let's take a look at what else was trading last night. Gold. Be keen to hear your view on volatility and also what's happening in the options space surrounding gold. It tanked yesterday. I mean, like this is the hourly view that I was watching when I was speaking to you late last night. But let's have a look at the daily view, because that gives you a better look at what's been happening, down 4% due to those easing geopolitical concerns. We got a trader friend asking, Monkey Man asking, what happens, do you think, with gold this coming weekend and in the sessions ahead?
Yeah, well, we got that sharp move down on the potential ceasefire agreement between Israel and Lebanon. From what I've seen, it seems like that was agreed in principle and has to be voted on further in the week by the Israeli cabinet and other members of that agreement. I think it looks likely to go ahead. Obviously, if there was a reversal in that policy and we don't get a ceasefire, I think you're going to see it bounce back up quite a bit. But if all goes ahead, I think you're probably going to see a little bit of a continuation of that downtrend. It's hard to say with a lot of the news coming out of the Middle East. You've also got the potential geopolitical risk coming out of Russia at the moment. So there's a lot of things feeding into it. It's quite hard to predict what's going to happen until we see more information and more news break.
So more about, buying or selling the fact rather than the rumor?
I think so, yeah. Clearly get a lot of a move on that rumor, but it's quite a hard one to predict at the moment, and obviously there's a lot of risk there. In the option space, yesterday we got a massive spike in volatility on that news. With a sharp move down, you generally get that type of volatility impact. It had eased throughout the rest of the session. I think we got the majority of the move in a sort of half an hour window after 1 p.m. UK time or 1:30 UK time. And then we get that sort of relaxed and a lot more stabilized trading throughout the rest of the day. And volatility's come back out. It's not really stuck around too much. So I think, again, we're waiting for news and we're getting that volatility impact on the news announcements. So yeah, it's best to keep an eye, and if you can catch the move at the time, you might get a little bit of value there before all the volatility floods into the market.
Totally. And trader friends, those of you that trade gold like I do, some people have given me this nickname. They call me the Niffler. I don't know whether you're aware of the Niffler and the Harry Potter magical beasts.
No.
It's this little, it looks a bit like a cross between a duck and a hedgehog. Yeah. Very complimentary, the look, I have to say. Quite tubby. This creature's quite tubby. And it loves gold. Anything that has gold, it tries to put in its pouch. And so I've had loads of trader friends sending me photos of the Niffler. It's quite funny. But
You have to send me that. I don't know what it looks like.
don't leave me anywhere near the Bank of England or near any sort of Chinese reserves. Let's just put it that way. But also watch the dollar. Those of you that trade gold a lot, watch the dollar, because obviously a stronger dollar also fades gold's appeal by making it more expensive for holders of other currencies. So whenever I trade gold, I always have the dollar up just to see what it's doing to make sure before I put the trade on. So make sure you have those guardrails in place. Obviously, always have stops and your limits as well. Always know when you're going to exit and when you're going to enter the trade before you go into the trade. Some other key points here. I don't know whether you're seeing any signals on this front, but although price volatility, Jack, I think will continue over the next few months as we wait on Trump's January speech, right? I still kind of think there's already a lot of buying exhaustion, is what I like to call it, out there. Is that something you're seeing on your side too?
Not too much on my side. Yeah, it's not too much. We've had
some of the bulls out there, like Robert Eckford, who is the head of Ruhr Gold, saying that he thinks gold will still advance towards $3,000 in 2025. I was a bull on gold before Trump got into power, but now that Trump is in power, and I think that he's going to have pro-inflationary policies, hence a stronger dollar, I've pivoted since his win, and I'm now a cautious bear. What do you make of that view?
Yeah, I heard a lot of people have quite hard targets on gold. It's, again, I feel like you can make these predictions, but a lot of the things that are feeding into that gold price are unstable and unpredictable to begin with. So if we get this continued escalation of geopolitical tensions and the continuation of Trump policy, I can see gold rising up to that point. But again, story changes every week. That's what makes it interesting.
That's right. Never a dull moment for Jack and myself. Jack, it's been such a pleasure having you on. We'll speak again tonight at 9:30. No, we won't. Don't worry. I'll catch you later on the trading floor. Have a good one.
You too. Thanks.
Corporate earnings reports are quarterly reports that reveal the financial results of a public company. They include valuable information such as revenue, net income, and earnings per share. Investors can use corporate earnings reports to gain insight into a public company's performance. They help investors decide whether it's time to buy, sell, or hold on to shares. So, how do corporate earnings reports impact trading? 1. They affect market indices because indices are made up of publicly traded stocks. Index values go up or down based on stock price movements tied to company earnings news. 2. Corporate earnings reports can signal a healthy or unhealthy economy. They could influence central bank decisions on interest rates and monetary policy. 3. Unexpectedly positive or negative reports have the potential to induce volatility in the stock's price and prompt activity in the market. 4. This surge of trading activity could result in more liquidity. It becomes easier to enter and exit trades when there are more active buyers and sellers. However, increased volume can also introduce greater unpredictability and price swings. 5. Positive reports can bring in foreign investment to a country's market. Negative reports could make foreign investors less interested and reduce their involvement. 6. An earnings report has the power to sway how investors feel about a company or the market in general. How an earnings report impacts the price of a stock depends greatly on what investors expected. If earnings exceed estimates, the price tends to go up. If earnings disappoint, the price often drops. Meeting expectations is key. Even good news might sink a stock if investors hoped for better news. Likewise, a stock could jump if bad news wasn't as bad as predicted. So, how do you trade corporate earnings news? The challenge is to work out how you might react to news that will thrill or disappoint investors. Have an action plan in place for earnings that exceed expectations, or earnings that might disappoint. There is also a chance that the earnings might be exactly what the market expected, and there won't be much price movement at all. Keep in mind that the market can be unpredictable, and these changes can happen in a flash. Option strategies can allow traders to trade big price swings in either direction. Strategies involve buying both call and put options on a stock prior to the report. Call options can protect short positions from rising prices, while put options can protect long positions from falling prices. Finally, it's essential to have risk management practices in place, such as an airtight trading strategy, stop-loss orders, and portfolio diversification. Consider bird's-eye view factors like industry trends, the health of the economy, volatility, revenue growth, and trader sentiment. With preparation, agility, and risk management, you're on your way to trading corporate earnings news effectively.
Hi, I'm Sean Murison, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Market Measures, my favorite part of the show, where we take you through the maths behind the numbers.
Right, everybody. So, yeah, today we are going to look at a review of the week. So, Sahil has very kindly put together a look at current market trends and everything that's gone on last week relative to the 2 weeks beforehand as well. So, let's go to a look at current market trends. Right, so the look at the index weekly performance, the S&P, we saw it's really gone up in the week of the election. It came off last week, as in the week of the 11th, and then we saw a rebound. So that, of course, is, remember, the American date form, 11th of November, S&P down 2%, NASDAQ down 3%, but then as of last week, S&P rebounding, regaining almost everything. NASDAQ hasn't quite, and then you can see the Russell and Dow there as well. The expected weekly move is plus 1.7%, and the actual was 1.7% as well. Then IV rank. How is the IV rank moving compared with remember, IV rank is how the implied volatility looks relative to its own volatility. So you can see there, S&P 500 is flat. Bonds up 1 week, down another week, not really any trend there. But gold has been increasing. That shows exactly why we saw such a big move, an extended move yesterday. it was down 3%, more than 3% in a day. And that's because we've seen in each of the last 2 weeks implied volatility increasing with regards to its own level there in gold. Euro as well, we see much of a muchness. As the euro's come off, the implied volatility rank of itself has gone higher. And then natural gas with that big rally as well. Okay, significant market moves. As we said, natural gas up 10.8% in well, that's a graph of the year, but yeah, in the last week, average positive move up 6, average negative move down 5, and then there we go, Ange. There is the one that we've all been waiting to hit 100,000, haven't we? Didn't quite get there. Got to 99,860.
I know, the hat is still hanging outside the studio, people. Rich, also, this is fascinating because we talked about this before the Trump win, and there was this expectation that smaller cap stocks would tend to do better, right? And we have seen this since the win.
The Russell 2000.
Yeah.
Yeah, it has indeed had a strong day yesterday, up 2.5%. It was with the Nasdaq down on the day. Then there you go. There's the long-term correlation Sahil's put into us for Coinbase against Bitcoin, 0.75. Right, there's the euro. So a 2-year low for the euro, down at 104. $3 US dollar down 1.3%. So that is right on that support line. Tried to bounce yesterday, got back up to 105, but we are seeing it small lower again on the Trump tariff comments today.
Oh, good. He's done like individual movers as well.
That's right. So
Supermicro computer, up 35% there. Keysight Technologies up 11%. Copal, not one I've traded before, up 10%. Vistra up 9%. Deere, I've definitely traded this because I love big engines and I cannot lie. And they produce a lot of agricultural vehicles, up 9%. There is a lot of, if you know lots of farmers in the US, there's a lot of feel out there that the relaxation in the oil and gas side of things will mean that it will be cheaper to fuel farming vehicles, big ones like the ones that Deere produces. So they have seen a boost or a lift in early inquiries for new vehicles. Target, though, down 25%, Insight down 7%. Alphabet Class A, this is interesting.
Yeah,
Parent company of Google.
That it had such a big move.
This is one I would not expect to be in the red. Intuit and AES also down.
Right, then earnings review. So what were the big movers from last week? It was Gap up 13%, John Deere up 8%. That was the big ones there. And then a review of the earnings. Look at that average return, right? That is showing you there really is no movement there. Back to Axel's point, everything is in the price. Well, it looks like certainly on the law of large numbers, everything is in the price when it comes to earnings. Right, what have we got today? Just a reminder, Abercrombie & Fitch, Dell, Best Buy, Macy's, Hewlett-Packard, Urban Outfitters, and Dick's Sporting Goods. So that's our look ahead at what's coming up. We'll go into those more detail and also a look at those all sessions movers coming up in What's Next.
Here we go. What's next? This is what we tell you about that will move or might move in the coming sessions, so you can take a position or express a view on it. Right, Rich, we're talking about Deere earlier on. Do you know what the first product that was invented that it created the company essentially that it is today?
So it wasn't tractors or cranes. it was something else?
No, it was in the tractor space. It was in
Okay.
agriculture, but the first, tool that was motorized, that was, became its cash cow to fund and create the company that it is today. Still, Trader Friends, it still bears the name of its founder. But what was the farming tool that became motorized, that kind of fueled?
So how long ago are we talking here? It must be 100 years.
Around
least.
1860s.
Okay, right, so 150 years ago.
Oh, nice. So we had Caleb saying, must be some plow or something. Well done, Caleb.
Plow, well
Woo!
done. The motorized plow, that was...
Scouring plow, because everything had to be done by, humans, right? Whoa, look, Caleb's like, whoa. Yeah, he invented the first and marketed the first scouring plow, motorized plow.
Very impressive. So that was John Deere. That was, it was one we traded a lot in 2007.
I'm more a Fergie kind of girl.
I just had to tie in. That's lost me.
So in the US, like if you had to buy a tractor or something with a
Right,
John Deere, but
Ferguson.
in the UK, I'm more
Fergie, right, yeah. Caterpillar. How have that?
Caterpillar.
I don't even know how that stock has done actually. So let's have a quick look at John Deere with regards to Deere. Why can't I find it there? Is it Deere Group?
Yeah,
it's not John
changed
Deere
its
anymore.
name, yeah.
Deere and Co. Right. Wow.
Yeah,
What a run it's had.
Yep, and look at the spike. If you look since around the 5th of November, can you see it dipped a bit? It went back up there.
We know what happened on the 5th of November, don't we?
Yeah. But also taking a look at, I really want to check on the all sessions, because having a look at my list there, some of the big movers today, Rivian Automotive, up 6.3%. JD.com as well, another gainer, up 1.68%. Rivian is an interesting one, because I think it was beaten down so much recently. It's having a reversal now. But for those of you that cover this space, a lot of the EV makers have been pounded. Northvolt in the last week, biggest, best funded, or so we thought, electric battery maker in Europe, went into Chapter 11, and there's been this whole concern now that with a Trump administration that EVs are going to have not just cheap petrol prices to contend with, but also tariffs as well. Rivian, one of those, but it looks like it's bouncing back at the moment.
Interesting. Intel only down 1.5%. So Intel, a reminder, Qualcomm making some comments overnight. I'll get those exact comments for you. So it's a story from Bloomberg News that Qualcomm's interest in acquiring Intel is said to have cooled due to complexities associated with the deal. The complexities, does it go into details of what those are? At that time, there's not too much more there, is it? It's just citing people familiar with the matter, which we never know who those people are. It never comes out, no matter what happens. We don't know the citing people familiar with the matter. So let's have a look at that stock. Only down 1.5%. I actually thought some more premium would be taken out there. But let's have a look at the others as well. GM down 2%. General Motors down 2%, along with the global autos on those tariff comments. Ford also down 1.3%. God, Ford must be getting down to the bottom end of its range now. Or has it had a bounce? I think it's been between 10.50 and, there we go, 10.50 to 11.30 for a decent amount of time now.
I know, it hasn't broken above that 11.30 level with proper conviction. And to me, this is still a stock in pain, people, until we get some conviction above the 11.30 level. I wonder
what it would take.
I know, right? It's been down there for such a long time, since July 2024 on the daily chart. But look at how far it's fallen since the middle of July. I mean, it was way back
Yeah,
at
those numbers were
1484. I know they were really awful, but like you were saying, like, what is it going to take for this stock to bounce back again? I'm not brave enough.
No,
Not brave enough.
No, it's been out. I've traded forward intraday sometimes, but I haven't really, had too much of a long-term position. It's just has never looked like it offers that much upside.
One I think that has potentially further upside, especially coming up to the festive season, is Delta Airlines, and it has already been on a roll
Gives
there.
me shivers. Knowing that Pega has a stop loss in there at 66.
Oh, she's got a stop loss at 66,
Yeah.
right?
It's just when you say it, I'm like, oh no, is it up 10%?
But it's more like a sectoral view, because even United, their what is that acronym again?
Revenue per passenger.
Thank you. RevPAR.
RevPAR.
Has been climbing in the last few weeks, and I like watching that, especially as we close in on the holiday season. And a lot of these airlines, not only is it the festive season, people, but also don't forget that a lot of Americans out there, I mean, even though it's not felt in the pocket yet, but they're kind of already kind of thinking, you know, it's going to be times when inflation is coming down a bit more, there's more money to be had. There are a lot of these parties around the country, which I don't quite get, and this is not a trader friend, it's not an ideological view, but are being sent all these pictures of Trump win parties. That's still taking place, and I think it will still continue into the Thanksgiving period, another high-flying season, right? And then after that, we've got Hanukkah, and we've got Christmas. Loads there of loads of flying to be done before then, right? So,
yeah, what else do we have? Well, let's go back to these UK moves, and let's see what has moved on and what has managed to rebound. So, there's not much rebounding there. Diageo down 2.5%, and the autos still as bad as they were as well. Volkswagen down 2.2, Porsche down 2.6, BMW down 1.5, Renault getting a small bounce. What about what's up on the day? Halfords, wow, Halfords is a performer. Halford up 13.3 now.
wow.
The relief is real. Yeah, we got small moves in Flutter, so much of a muchness after that. Rheinmetall. Girlfriend still got her position in that, as well as BAE. Sorry, Rolls-Royce, what am I saying? Vodafone also slowly clambering back up, 71.40 now. So that's with the dividend back in, 73.4. Now back above where it was before those results that you spoke to me when I was stuck in the hotel room up in Birmingham, I think that was.
Was it Birmingham or your super expensive hotel in Edinburgh?
That one was the Manchester one was expensive because the VMA Music Awards had just been on.
Oh.
So we had expensive Edinburgh because the rugby, expensive Manchester because the VMA Awards, which we missed, unfortunately.
I'm glad you brought up Halfords. So it's one that I have a position in. I'm thinking now that you brought it up, it just reminded me, maybe I should add to it, because for the UK, I like Greggs, I like Halfords, I understand the business model, and Halfords have this thing that they do that's similar to, you know, you're like, Andrew, why are you always so crazy? I am crazy. That's why I sit here
Not
with
at
Rich
all.
every day. And you're like, why is it you look at the, you know, back in the day, obviously they've spun off Costa now, but Whitbread.
Ah, yes.
And I was like, so they get it. Like they have that cheap hotel always next to
The
its,
Premier Inn.
yeah, and it's always next to one of the restaurants that they own, right? Whether it's a cheap carvery, whatever. But Halfords has the same thing. And for a long time, trader friends, if you don't believe this, go and when you're driving around town, have a look. They're always next to a Pets at Home.
Really?
Yeah.
Interesting.
Old Kent Road, I think Halfords have moved now, but it's always either next to a Pets at Home or B&Q.
Yeah, well, that's why I was worried, and that's why you're seeing the relief in the stock today, right? Because if you've got a B&Q and you've got at Halfords, it's the same kind of spending, isn't it? It's the same kind of consumer. So if you've seen a slowdown at B&Q Kingfisher, where are we seeing the same at Halfords?
Exactly. And those give you true indicators of whether or not to short or to go long the stock. So like Rich rightly said, if you think, you know, Kingfisher, you put Tom Roberts on the spot yesterday, I watched it. You're like, do you do any DIY? B&Q, incidentally, guess what the biggest margin, one of the biggest margin products is? I would never buy that product, by the way, at B&Q. Well, I use B&Q, but I'd never buy that product.
Hot dogs.
No, it's actually their buckets.
What was your hot
You know
dog
the rubber-
stat?
Oh, it's the Sizzler in...
Walmart? Target?
No,
Home
come
Depot.
on. Cam would know. Where is that hot dog that everyone in the US raves about? Costco.
Costco, that's it.
I've
Yeah.
never had one. Cam says he's going to loan me his card or sneak me in. But I've heard about this Sizzler, this hot dog, like from West Coast to East Coast to even here. And Cam sent me a photo. But yet again, indicators, people, sometimes it's really good to understand why things work and whether they have a business model that works. And I think this one does. They always have a Halfords next to a B&Q or a Pets at Home. And if they're not doing well, or if they're doing well, then the Pets at Home is likely to do well, right? And also, they have these fusion garages where you take your car in and you do everything, all in one stop, one shop. And I think they're rolling out another, is it 40 or several others in the country? So they seem to be doing well.
Well, there's Pets at Home as well for you. So that has been struggling as well. That's just over a year. And you can see dropping down from 310 to 276. Pets at Home, as long as I remember it, has been at £3. You know, that I think going back to 2021, it's been there since there was a recapitalization or there was some kind of refinancing of the debt, perhaps, that got it up there. But you can see maybe, you know, pets have obviously been huge since
Lockdown.
COVID, but maybe people are struggling down and not buying all those pamper tools and yeah. No.
Actually, Pets at Home looks like a good options trade, right?
Oh, yeah, good luck on getting options on that one. Blimey. Good luck.
It's just very meh. It's just very meh, isn't it, this chart? Look at that. And on the way down, I think it needs to revamp that. Right, let's have a look at some of the other all sessions and also Germany 40. We haven't taken a look at German stocks today. Rheinmetall up there 2.3% higher. MTU Aero Engines also higher. Rheinmetall is interesting given that we had that decrease or the easing of geopolitical tensions yesterday, but it's still higher there. As I said, Rheinmetall and Hensoldt, one of those, they're like the Hermes of the defense world, right? And BAE Systems, because they have their fingers in so many pies. Siemens Healthineer also up, but really, it's the losers board that I want to look at. Buyers down 3.7%. The automakers also hurting. Daimler, Truck, Porsche, Volkswagen also.
Yes.
Yeah. Oh, I've zoomed in a bit too much. There we are.
God, that's perfect. There we go.
BMW also down there, and Mercedes-Benz down 1.4%. So the car makers getting whacked.
Right. Do you want to have a look at some of the expected moves that we like to see on the companies reporting today? So we've got Abercrombie. We're expecting a $20 move on that stock. Wow. So 12% move we're expecting on Abercrombie. Dell, we are expecting a $13 move off 144 share price. So a 9% move in Dell on numbers. This is incredible. This is a real volatile day. Urban Outfitters, we are expecting
Dear Lord, are they still going?
almost a 9% move as well. Woof, this is going to be some day for numbers, this. And then finally, HP. So HP, surely something more. Now, is it Hewlett Packard? Common stock, there we go. HPQ, is that right? Yeah, there we go, a $3 move. I don't know if I've got the right Hewlett Packard there, actually, because that's only showing...
Yeah, it's just the HP.
HP, Hewlett Packard Enterprises? No.
HP, yeah. Just HP? HPQ?
Yeah, I think that's HPQ.
Yeah.
So yeah, there we go, only a 1% move there expected on Hewlett Packard. And then finally we had one more. What was the other?
Was it Best Buy? I feel like
Macy's. Oh, Macy's. Well, Macy's aren't reporting.
Is it
That's
Best
one
Buy?
story we didn't cover, actually. Yeah, Best Buy. Let's have a look at Best Buy. Did you see the problem in Macy's?
No, what happened at Macy's?
Oh my goodness. So
I call it flammable superstore. Everything they sell in Macy's is itchy and flammable, people. I would never buy any clothing from Macy's.
I actually used to live opposite the one on Broadway and 34th.
You've got
in
such
Manhattan.
refined skin. How can you buy anything from there?
No, I didn't buy anything. I just lived opposite. I also got shot in a drive-by shooting outside Macy's.
No.
Yeah, I was standing at traffic lights coming home on a Saturday night, and it was about 2 o'clock in the morning. And the traffic lights went to green, and I heard this screech of tires, and the car pulled away, and I noticed somebody with a gun outside the back window, and then I heard the thump of the gunshot, and I went down, and it got me right in the hip.
No.
With a paintball gun, people. Don't worry, it was only a paintball gun, and I had green paint all over my jeans, but I had a massive bruise for about 4 days. That was my getting done in the drive-by shooting outside Macy's. But Macy's hopefully will not get a drive-by today, because we're looking at an expected move of 82 cents. However, the story yesterday that I was coming on to was a $130 million hole in their accounts, because
Oh yeah, that's right. Do they know why yet?
there was an employee who was hiding delivery costs for 3 years.
Nice.
150 million
3 years.
of 3 years. I mean, how do you miss that? That is something else. So yeah, so Macy's, I think, are holding back numbers. Right, well, that is nearly us. Just a quick word, everybody in the chat, let's, it is a place of love, it's a place of community. So yeah, whatever is mentioned in there, then let's all respect each other and try and keep the best whatever the mood is.
Right, and on that note, we will see you with bells and whistles on tomorrow, same place, same time, with myself and the wonderful Rich McDonald.
And also at 9:45, we will be addressing all the things around, things in this industry that involves investing, involves trading.
And
then
guardrails.
it is, definitely important to have those safeguards in place and the guardrails. So 9:45 tomorrow, we'll be chatting more about that. Have a fantastic day.
Stocks gap and hold. Is this the Besant bounce? It's Monday, November 25th, 2024. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. To take you through the rest of this hour as we wrap up the futures trading day. Brief programming note, only one of 2 Overtime episodes this week because we are off Wednesday, Thursday, Friday for the Thanksgiving holiday. So get your Overtime while you can get it. We will not have any extra servings later on. If you're joining us here, of course, tell us what you're trading. Come join the YouTube chat or head over to tastylive.com, see what we're all about. Gentlemen, it's good to see you after a weekend where we had some exciting news come out, at least of DC. Scott Bessent, the macro luminary known for his accolades and ventures with people like George Soros and Stanley Druckenmiller, he himself having built a very successful macro hedge fund over the past few decades, is now going to be the next Treasury of the Secretary. Nope. The next Secretary of the Treasury. We got that right. It's good news for markets here today because it seems like he's a stable hand, someone who really understands the complexities and intricacies of financial markets. And that is the defining news flow from the weekend, at least, as we turn to the charts. And we see an S&P 500, a NASDAQ, a Russell 2000 that all gap open higher and hold on to those gains across the day. We see here that it's the bond market that perhaps puts in the biggest move, some of this relief that maybe we're not going to have a Treasury Department that's completely off the rails. Scott Bessent's move brings the bonds back up to 118. It's a full 2-point move here in ZB. All's well, at least on that accord. But then 9 a.m. Eastern rolls around, and we get a news of a ceasefire between Israel and Lebanon, Israel and Hezbollah. Gold falls out of bed. Ilya, you and I were talking about this on Futures Power Hour, the juxtaposition between when I was writing this morning and when we were actually on air. That occurs in tandem with crude oil falling off the face of the earth right around the same time at 9 a.m. Eastern. So there's a few things in play here today, guys. Ilya, for the sake of spicing things up, you and I already spoke. Let's get Dylan's perspective first on this Monday.
Yes.
Radigan, what's your take from Europe these days? Russia, Ukraine.
Before we do all that, is there a word for when you have a strong conviction for a trading position that you never put on, and then you're validated and that trading position plays out perfectly as you would hope that it would, but you never put it on?
If we call the high
when Chris
conviction
and I spoke
trades,
earlier, I called it a Pyrrhic victory because I had one also over the weekend.
So what was it? But I didn't hear Chris's answer. Pyrrhic victory is good. What is the word for when you have a really strong conviction for a trading position that you don't put on, that then materializes perfectly as you envisioned it, and then you just watch it play out before you and feel a slight sense of validation that you were correct and an increasing sense of dread that you're so stupid as to not do it, and meanwhile you own the bond and it continues to go lower? Is there a trading vocabulary word for that specific experience?
Yeah. You have what the crypto bros call FUD, fear, uncertainty, and doubt.
Because I got to tell you, my hypothetical gold short, which has been on for weeks now, a barn burner. I mean, I was hollering about it here even. Unbelievable.
You're a billionaire on paper, Mr. Radigan.
Yeah. No, in fact, both of us last week said, you know what? This rally in gold is bananas.
Yeah.
I even pointed out the level.
Sure. Imaginary drinks are on me. Imaginary drinks are on me.
I'll split the imaginary tab with you. I meant the same thing.
Anyway, well, you guys are splitting your imaginary tab. Someone's got to pay mine because this long goal position is costing me a pretty penny here. Dylan, go on.
You were attempting to ask a serious material question about global relations, politics, war, life, death, resources, and the future of humanity. I wasn't sure exactly where you were going.
Are we done with the Middle East right now?
Yes.
I mean, in terms of a catalyst, right? Ilya laid out a very convincing argument before that if Hezbollah is going to the negotiating table, then it probably means that Iran is pulling back these aggressions entirely, and tensions, broadly speaking, will cool down because Hezbollah doesn't operate and exist without the support of the IRGC and the Iranian government writ large. So a ceasefire deal between Israel and Hezbollah that follows the same contours as the UNSC 1701 resolution put in place after the 2006 war, that probably means we're past the crescendo. We're definitely in a state of decline in terms of the Israel-Iran chapter as we know it to exist. Would you agree with that assessment that this is a seminal turning point today, given what we saw in gold and crude?
I mean, I would agree with it, and partially I agree with it because of the market's interpretation of it, and partially I agree with it just because I believe the geopolitical winds of change are blowing in a way that is favorable for de-escalation. I think it's in everybody. Tell me who's in. The question I've been asking myself, whether it's with the Israeli situation or the obvious one in Ukraine, is in whose interest is further escalation? especially as with the political transition in the United States, and especially with the amount of destruction and exhaustion that has to be setting in, even on the protagonistic side, and I use the word protagonistic probably incorrectly, but in the aggression, like if Israel is the aggressor and Russia, if Israel and Russia are the two aggressors, they too are, I'm sure, surely deeply exhausted, but just politically and psychologically. And again, I would say maybe the Israeli and the Russian government are among the most sort of psychologically immune and relentless, or famously sort of stubborn and fixated on their various when they get into something. But reality is reality. And what I mean when I say reality is if there is an off ramp or a de-escalation ramp that does not cause either Russia or Israel to lose face, and at the same time allows them to create a perception, rightly or wrongly, of massively enhanced security as a result of what they have done. In the case of Israel, the massive degradation of Hamas and a message to the world that is, you know, the obvious one, which is do not F with us. We will go anywhere. We will do anything. We'll everything from the obvious in the invasion in Gaza to the northern incursions to the beepers, all the things that have happened there, and the same thing really for Russia, which is because all Russia's going to want to walk away with is some sort of a security guarantee. Ukraine's going to get a security guarantee. I know I'm way ahead of myself, and the war's ongoing, and maybe it won't end, and blah blah blah. But I think it's going to, and I think it'll end with a neutral Ukraine, excuse me, and a security guarantee. And I think this, and I'm hopeful that the appearance, I won't say of a Hezbollah surrender, but a Hezbollah submission to engagement, which creates at least the optics of Israeli domination, right? Of a dominant and submissive counterparty through military and diplomatic channels. And if basically everybody can exploit the change in power in the United States to posture for a fresh start, which is what any presidential transition represents, regardless of who was coming in. But the fact that there's a change in party, all those things. And so coming back to the financial markets, I'm hopeful that, I mean, normally when there's a bid in oil up on fear of escalation, I'm always the first one to say, sell it. I am at this point actually hopeful that some of the relief or the decline, the gold chart that you're showing and all the rest of it is more valid this time, that there actually is a pathway to a de-escalation, which is in the collective self-interest of all earthlings, and also I think in the self-interest of even the Russian and the Israeli government, who are the two that are probably the most challenging to guide to an off-ramp at this point.
Ilya, the interesting
the last thing I'll say is, I know I'm sorry for the monologue, but I do think that at the very least that's very much with the sort of the hope in Berlin or in Rome or in Paris, I can't speak for the British government or the American government, but the European government, but certainly the French, German, and Italian government is very hopeful that this is going to de-escalate. And there's enough rhetoric in the American government that suggests it. I think the British government is the only one that may be still a hardliner on wanting to go to war with Russia, but we'll find out.
The British government may be. The French government today, in Le Monde, there was a story, the major French newspaper, that the U.S. and France are having discussions about what a troop deployment in eastern Ukraine would look like, which, again, for the life of me, maybe that's just posturing.
I only hope. I mean, and good luck getting the Germans on board. I mean, there's a reason the German prime minister had that phone call, for better or worse. But we'll see. I mean, we'll see. Maybe I am too. We'll see. We will see.
Ilya, this odd market movement outside of the close at 4 p.m. Eastern aside, where the S&P's bounced about 10 points for, I don't know, no reason. The market was relatively contained today, right? We broke out higher out of the gate. You guys were covering this on First Call last night. We had our little crescendo this morning. We get our 9 o'clock a.m. Headline there. It sinks gold, it sinks oil. Stocks in a little bit of a kick to the upside into the open. And then we spent the rest of the day fading. We're more or less back to where we were right around 7 o'clock this morning. So I guess that was all for naught. What do you make of a candlestick like this today? I know it's a doji, but it's a pretty high volume day. 1.5 million contracts traded here in ESZ4. That's not nothing. How are you approaching this market now as we go into, I mean, taking a step back for a second, I am treating tonight like a Thursday night. Tomorrow is a Friday. Well, for all intents and purposes, the market's open on Wednesday. We're not going to be on air, okay? I'm going to be doing very minimal trading. The liquidity will be thin. So tomorrow's my Friday. That's how I'm treating tomorrow. So how are you approaching tomorrow after today's action?
I think what this looks like is essentially the market getting a headline, having a singular response, and basically saying, okay, all the news in this announcement, such as it is spent basically on the initial reaction. What do you got that's next? Because what you see here is the market essentially gets into the top of the range that established after the election, but ultimately doesn't go anywhere. It gets up there, it touches up there, goes, all right, fine, good. Then it comes right back because immediately all of the speculative interest is exhausted. And this, I think, is a more general state of affairs here, seemingly, where, okay, Besant is better than somebody who doesn't know financial market architecture, who hasn't spent decades steeped in the global macroeconomy. So obviously, this selection gives you some degree of confidence, unlike, let's say, the now defunct Matt Gaetz nomination for DOJ, because whatever you think of Matt Gaetz, this or that, it doesn't really matter. Bottom line is, here is a person that doesn't have or didn't have relevant experience running a complex bureaucracy. In Besant, what you have is somebody that's run things and that is steeped in the relevant information. So, understandable from the market's perspective. Okay, well, this is not a controversial sort of choice. But what else do we know? Very little. We don't know what the policy is going to look like beyond what we already knew. There's not anything here in this news other than seemingly the sort of episodic sigh of relief. And so we're left basically unchanged. For me, that leaves the FOMC minutes tomorrow, and to some extent the PCE inflation data on Wednesday, early AM, as interesting waypoints, because what we've seen is the market has not liked when you get the recent kind of admission from the Fed that the markets have already essentially showed everybody since mid-September, which is that they're not going to do as many cuts next year as they thought. And when you get that last big leg down in the S&P, that's when retail sales data and Jerome Powell's comments after November's FOMC, not the meeting, but a week later, that's where that sort of gets cemented. My sense is that neither the FOMC minutes nor the PCE data are going to suggest anything otherwise, but they may not suggest anything new either. And if they don't suggest anything new, then we're kind of in a no man's land. Because unless the PCE is a lot hotter than expected, or the FOMC minutes give you a much more hawkish Fed than the markets have already set up for, what's the catalyst then?
Besant was one of the front runners, and contextualizing everything that he could have an agenda with or oversight on as Treasury Secretary, where his influence could be. I think about tariffs, taxes, and the trajectory of the government debt and spending. Besant has been a strong supporter of tariffs. He sees them, however, as a tool for negotiating better trade deals. He thinks that they can be used strategically to achieve economic goals. That doesn't mean blanket tariffs, right? Lutnick is the blanket tariff guy. Besant's probably going to be pushing back against this. And if you believe the reporting from over the weekend, Lutnick was actually pushing back against the Trump team when they were trying to choose Bessent. He was trying to push for anyone other than Bessent. So maybe you're going to have a counterweight there. In terms of taxes,
well, what was the logic? What was Lutnick's logic in the no Bessent appointment? Weak dollar, again, strong dollar.
Well, interestingly, Bessent walked back the whole shadow Fed thing, which was his idea. And he's walked it back, which I don't know how related all of that is, obviously, but that's a thing. He now says, no, that was not the good idea, and then gets nominated. So I don't know if that means anything.
I think if you trust the reporting here, if it's accurate, then it's because he's not a big believer in tariffs the way that Bessent is. And quite frankly, Lutnick, I think, wanted the Treasury Secretary job. So why not undercut someone who's holding a position that did Steve Mnuchin leave? You know, Mnuchin is probably he was a cartoonish villain going through the confirmation hearings for Democrats. And he comes out the other side, and Democrats now love him, think he was the best cabinet member in Trump's first term. And I think Bessent's going to kind of cut that same cloth, where he's going to keep his head down and not make too much noise and let the work speak for itself. He does have that traditional Republican orthodoxy on taxes. He thinks that we can stimulate growth by increasing spending and growing our way out of the debt, which I don't think is realistic, given what we've seen over the past 20-something years since the last time it surplus.
Ridiculous.
It's more trickle-down economics. But then again, with the debt, he thinks that we can reduce the debt over time. He wants to aim to foster growth rather than immediate austerity. So when thinking about all this, are we going to get the significant spending cuts? Unlikely. Are we going to get the significant tariffs? If Bessent has his say, no, it's going to be a more measured approach. And so the bonds today are going into a world where maybe there's not a shadow Fed toying with the independence of the U.S. monetary system. Maybe there's not a turncoat, someone who's going to quickly be in and out of the door at Treasury, someone who's going to stick around for a long time. And then also removing the risk of Kevin Warsh. It was only last week when I really delved into what he was saying throughout the global financial crisis that I went from being like, oh, you know, he's a former Fed official and, you know, that's not a bad thing to have around to, okay, this guy is probably a former Fed official because he misread the room completely in 2008. If you go through the Fed transcripts there, in the summer of 2008, he was arguing against providing support to the banking system and saying that we needed to be worried about inflation and potentially rate hikes. And that's clearly, in hindsight, a terrible misread because the banking system was in the middle of breaking down and collapsing. And he was one of the voices in the room that prevented the Fed from being a little bit more aggressive up front, which we know in hindsight was the wrong thing, which in turn, what's the lesson that we learned from the global financial crisis? You throw the kitchen sink at everything. And how did that work out in 2020 and 2021? We prevented a recession, but we got all this inflation. So we're constantly fighting the last battles. He would have been a guy wrong in the last battle and probably is one of the people that led things to be as bad as they were for as long as they were, because the Fed and other government institutions did not act swiftly enough at the start of the crisis. And then, Dylan, as you very well know, as I came to admire you many years ago, when the government did act, they didn't help the right people. And they bailed out.
They facilitated the largest theft and cover-up in the history of the world and set the table for a president like Donald Trump. I mean, this entire Trump situation, not to mention the inflation situation, is a direct consequence of the objective catastrophic corruption of the entire financial system in 2008 and 9 with a resolution that was to cover the entire thing up and villainize one reckless counterparty, which was the mortgage borrower, and pay off the other reckless counterparty, which was the entire lending apparatus. Which then set the table for the world to be like, oh, the establishment is corrupt and they cover it up. Unfortunately, the person who came in most effectively with that message was Donald Trump, who is the king of corruption, ironically.
Yeah, I want you to go into that a little bit more. There's a great perspective that Victor Jones and I talk about. Chris Cole wrote an essay a few years ago about how volatility isn't eliminated, but it's basically transmuted through markets in different ways. So you get a big volatility spike if policymakers come in and take actions to quell the volatility. They're really just sweeping it under the rug somewhere else. So an extension of that theory, Victor and I have had this conversation where the volatilities, the societal volatility, or excuse me, the financial market volatility that arose in 2008 was not eliminated. It was pushed under the rug of becoming societal volatility, right?
That's right.
And you see in the Eurozone debt crisis and the balkanization of politics, if you will, over the past 15 years.
The last vestige of any trust or credibility in the establishment was eliminated.
In some sense, it's the flip side of the coin of what successfully happened on the monetary policy side, where a huge amount of QE did not generate inflation, because what it did was take a giant liquidity hole and fill it. It didn't actually create any new money. It went and took illiquid money and turned it into liquid money. It basically assumed the market's liquidity risk, because the Fed itself does not have a liquidity constraint. It doesn't have to put up margin requirements and have reserve capital and all these things. So all of the success in basically taking the market's liquidity risk, which was the essence of the credit crisis, shifting it successfully to the Fed, and avoiding what could have been the Great Depression times X number of orders of magnitude. The flip side of that is on the political side, the abject fiscal failure.
And the biggest failure was that because the resolution tried to pretend that the bank CEOs and board members had not paid themselves billions of dollars in the preceding 4 years for all of the risk they were brilliantly managing and all the incredible loans they were brilliantly issuing into the mortgage market. And as a result, Bob Rubin and friends were paying themselves $100 million per year per person because of their absolute genius as financial geniuses leading the world. Because the solution basically allowed those people to keep the billions of dollars they'd taken out of the system. The consequence of that was a complete and utter and absolute collapse in trust in the U.S. government from top to bottom, only further compounded by the fact that instead of solving it when Barack Obama was made president, they ignored it and then facilitated a massive giveaway to the private health insurance industries by mandating everybody buy health insurance into an unreformed monopoly, only further jacking another few $100 billion into the financial system for the financial executives. So first they rake the table on the bank side, then they rake the table on the health insurance side, and then everybody wonders why a president who says this entire thing is rigged in a con job is the most popular guy in town, even though he's not that popular. And then if you look, the most interesting electoral map from this election, and you could do it from the last elections, is if you created 3 categories of eligible voter, those who voted for the Democrat, those who voted for the Republican, and those who were eligible voters but did not vote. The no voters crush both the Trump, like you basically, the combined Trump and Harris voters barely beat the no voters, and standalone, the Democrat or the Republican voters get annihilated by the no voters. And I interpret those no votes as a complete loss of confidence in the American political system. And I believe there's been a complete loss of confidence in the American political system, which has been going, that's been coming on since 1896, ever since they screwed over William Jennings Bryan back in the day. But it's been coming for the past 100 years. And then they really brought it home in 2008 and 9 to the point where basically there's the majority of the American eligible voters believe the entire system is a non-functioning, corrupt regime. And Donald Trump, who's maybe probably the most corrupt person ever to be a leader of any nation, certainly for the United States, brilliantly exploited that pre-existing condition, which in my opinion was created or certainly cauterized and focused as the central organizing principle by the corrupt nature of the resolution in 2008 of the financial crisis. And now the chickens have come home to roost. But the great irony is maybe he's going to make America great again. Who knew? You can't rule it out.
I don't know if we are going to see the kind of disruption, at least from the market's perspective, early in the next administration that people are worrying about. I'm starting to think about a world where we look to those Fed funds futures right now, Ilya, and we're quickly starting to see some shifts for 2025 and 2026 where the market is moving into a place where, forget the bond moves today. We're thinking that maybe rate cut odds are fairly cemented for the near-term path, and we could potentially be looking at a world moving forward where we need to start thinking about hikes again. That's not my opinion, right? But when you look at the Taylor rule, if you look at what some of these Fed speakers are saying, we see that there's only basically 2 cuts priced in now for the rest of the cycle. And Bowman last week told us that she was against it, right? She was the one who dissented in November. It's the first time we saw a dissent on the FOMC in 20 years. Tomorrow, we're going to get those FOMC minutes. Is this the start of a rhetorical turn by Fed officials as we turn into 2025?
I think it's probably too early to say that it's a full rhetorical turn. We're going to have to see what the summary of economic projections looks like in December. I think what you have here is the opportunity for the markets to kind of say, we've heard everything there is to hear near term. The Fed is not going to hardcore about face on anything that happens between now and the December FOMC. The Fed, I think, understands that as inflation expectations have come down, so too they've needed to cut to make sure that real rates don't run away on them. But also that when in September they said that they're going to do 100 basis points in cuts in 2025, nobody believes this anymore, certainly not the markets. If you look at what the markets have baked in for next year, at this stage, it is a meager 60 basis points. So 2 cuts with some slight, less than even optionality on a third. If U.S. economic data continues to look hot, those 2 are going to get probably cemented as maintenance. It's a long year. Who knows? But at least in the near term, the markets don't have anything to tell them this is definitely not right. Until the Fed itself comes out in December and goes, here's our forecast. And then the markets will say either the Fed is on the dovish side of where we are, or we're on the dovish side of where the Fed is. Let's even this out, and that'll be what we start with in January. There are too many variables beyond, let's call it the first quarter, to really say, because you're about to get a new administration. There's a big refi cliff on cheap 5-year COVID money that U.S. corporates gorged on during the pandemic, which is why the rate hikes haven't really hit them yet. So we're looking at a situation at this point where you probably don't have much that's in motion. And because there's not much that's in motion, you maybe have room for the markets to go, you know what, my speculative capital shouldn't be sitting in open exposure on these things. Essentially, every marginal person that had money to bet on reflation over the past 2 months has bet the money. And that may give you just a correction into the end of the year. It doesn't change anything structurally, but it might give you higher bonds. It might give you a weaker dollar for no reason other than it's been a long run and we're out of fresh fodder.
Well, one of the hallmarks of today's market was the strong distribution that's seen throughout. Equal weighted S&P 500 up 0.92% compared to the market cap weighted 0.47%. QQEW, again, equal weighted NASDAQ up, closing at a new all-time high, up 1.04% compared to the broader NASDAQ 0.31% gain. On a sector by sector level, home builders are your top performer in today's session. ITB takes the cake with a 6.12% surge. We see home builders otherwise in XHB posting a 5.22% surge. It's not just the home builders, it's retail as well. There is a nice breakout that just took place here in XRT. This to me is the most promising chart in the short term. If we're going to work backwards from the assumption that stocks are a discounting mechanism for where the economy will be in the future, and typically markets lead the economy by somewhere in the neighborhood of 6 to 9 months, XRT is the retail ETF. Studies have shown that if there's one ETF that suffers the most during recessions, it's XRT. XRT is breaking out. XRT is breaking out. XLY, which you could argue about the Tesla influence, but this is now closing at a new high here today. I look at SMH. This is not exactly a top performer, down by 0.39%, but isn't this kind of what we want to see, Dylan? This is an abundant rally. It's not just for the top 1%. It's not just for the Mag 7 names. This is a rally for everyone. We're beginning to see broad participation.
I agree with that. I think that that's one of the best signs going, actually, is the fact that that's what's going on is the most encouraging thing. I mean, I think that actually the market is very healthy, relatively speaking. And I know you talked about it a bit. I didn't make too many comments on it, but I do think that the Treasury Secretary was net positive, particularly when people were looking at the Hegseth nomination as an indication of sort of skill and profile, or the Gates nomination as an indication of skill and profile. You know, that moving towards a Treasury Secretary who has some qualification as opposed to just, you know, someone that he saw on TV is a good thing, you know, and I think that the market is behaving in a way that is validating to that idea.
Ilya, as the resident bear, what are you seeing in this market right now that gives you confidence? Or, gosh, I want to alliterate, and cowardice is not the right way, but hey, we're going to go confidence or cowardice. Like, what are the road signs that you're seeing here that tell you now is the time to jump in, or it's time to pull back and wait until the other side of the holidays? Is there a wall of worry? What's not in the wall of worry right now? Break it down for us, just to give a little bit of counter-positive spin to what Dylan and I are preaching here.
I think the same sort of speculative exhaustion that you have in the down move in the bonds, the same kind of speculative exhaustion that you have in the up move in stocks, or in the dollar, rather, you have in stocks. There seems very little reason why an incremental dollar should go to making a higher high between now and the end of the year. That doesn't mean it won't. But it's difficult to imagine what is going to go right here, barring peace breaking out more broadly than just Israel and Hezbollah, which clearly did not give the market enough juice to get all happy and excited, even, by the way, as gold cratered, even as crude oil fell. So it's not really helping enough. The Besant news obviously moved the bonds, obviously moved the dollar. Couldn't move stocks, though. Couldn't give them a lasting rally. So we seem to be looking at a situation where the driving indexes are lacking for steam. Take a look at the Russell. It really tried to take out that swing high today and could not do it. Could not close above. Instead, giving you what is about as textbook of a shooting star, which is a exhaustion signal, as you can imagine. At the same time, your momentum indicators here, I look at RSI because I'm a simpleton and I like things that you can draw in one line with a crayon, but you have here...
But it comes from the moon cycle. It comes from the cycle of the moon. I just can't get over that.
RSI does?
Yeah, that's why it's set to 28 days. The guy who invented RSI wanted to make it centric around the moon cycle.
That's interesting. So
Google it, kids.
28. I mean, Wilder came up with RSI, and to me, it's the simplest arithmetic in the world. It's a ratio of closes up over closes down. So it gives you a pure kind of arithmetic momentum indicator. And I don't really believe in overbought and oversold, but when something loses the propensity to close up even as it's setting higher highs, that's just third grade math indicative that you're running into some kind of a trap as far as the capacity to keep the pace that persists.
Oh yeah, I use RSI too. I just set it to 21 days because the arbitrary default setting of 14 days because it's half the cycle of the moon. That I can't be on board with. But
that is a little strange.
The arithmetic of the indicator makes sense to me. So like I set it to, you know, when I'm range trading, I set it to 1 month effectively.
Yeah, I'll usually look at a 20 or something like this, but the differences for a divergence calculation don't really make much of a difference. And you see them here in slow stochastics, you see them in MACD, which are essentially somewhat slightly complex versions of what RSI is, which is just an oscillator that gives you relative momentum. All of these things, they're all showing the same thing. They're showing you that momentum indicators are fading despite the higher high, and that you couldn't make good on a close above the swing top here sort of reinforces this whole sense of the thing is overcooked and it's struggling. So for me, all of this says can't make hay of what bonds, currencies, metals are doing. Obviously, it's having an impact, but stocks can't do anything with it. Technically, momentum is fading. Feels like maybe there is the urgent need for new narrative. And at this time of the year, that's going to be hard to come by, which probably gives you some room to correct back down. Not for any structural, the rally is broken reasons, but just because you're out of speculative juice. And while I don't have any exposure in the Russell or ES, I took ES off, as a matter of fact, early last week after it seemed like the downswing I was in had lost its way, and I was concerned about giving away my P&L, so I just took it. I still have the NASDAQ on, and I'm structuring a put vertical basically from the election high. So actually, the trade is narrowly in the money still. So I'm happy to sit with it here. Nothing has changed. The Besset bounce didn't last throughout the day. The Hezbollah bounce didn't last. That's curious. Obviously, the markets care. Look at gold, look at oil, look at the bonds. The markets care. Look at the dollar. They care. Stocks can't rally on it, though. It's a little suspect.
But don't you think, I mean, I still feel like the market, from the equity standpoint,
sure,
I'm much more inclined, you know, I mean, it's been my absolute worst domain of trading this year entirely, with oil obviously having been the best. So I take anything I say about the equity market with 4.5 cents, but I just don't see how you can't be optimistic for U.S. stocks.
Generally, I agree.
Yeah, I mean,
generally, just maybe not in the next 2 weeks.
Yeah. I mean, I'm not even going to pretend to have that.
Yeah, I mean,
take a handle, but I just feel like the underlying situation is stock positive. The economy is good. The labor market's good. The transition is basically, you know, anti-regulatory and low tax, which is basically good.
Mm-hmm.
You know, inflation is really your only risk. Inflation and some version of chaos, and the Treasury appointment sort of is a chaos hedge. The Howard Lutnick, you know, is somewhat of a chaos hedge. You know, increase, you know, the sort of at least the optimism for a decline in war, which may be, you know, naive and delusional on my part, but I just think that most of the marginal. I mean, I guess my only question for you, Ilya, is where are we? Or both of you? I just haven't seen it. I've maybe just kind of looked. Where are we on the inflation side of the ledger? Relative.
So this to me is the biggest thing, right? All those things you've just listed, we know.
If only to point out where
are in the price.
Where we're with inflation, you just said don't trust your word on equities because it's just your 4.5 cents. The expression is my 2 cents. So inflation is clearly destroying the value of the pennies with which you offer your advice.
That's why I got to bid 4.5 cents just to give a point of view. You used to only cost 2 cents.
Right? So I think you just gave us the answer there.
Spreads have widened.
It's still a problem, inflation. No, I all day today, Bloomberg Radio this morning, they had a queue of guests. We're like, yeah, the Fed. It's funny how the market always reacts to the Fed. The Fed did exactly what they said they were going to do this year, basically give or take a rate cut, maybe. So when they tell us that they may only cut once or twice next year, and they're going to leave the door open in their forecast for a world that you could see hikes coming again by the end of the year, don't discount it. I mean, there's more than a few people now that I'm listening to that are saying inflation contingent upon the way that the policies are rolled out in 2025, which is a big asterisk because we don't know what's going to happen. We're going to get a continuing resolution to start, but we get a second continuing resolution. What if the continuing resolution costs Mike Johnson his job? Because we're talking about a one seat pickup from last time. Could you get thrown into a period of turmoil where we have to have a new host of, speaker elections? It's certainly not a non-zero outcome right now for markets. But the inflation issue for most, I think, took a big step down today, right, Ilya? I mean, oil pulling off the board and gold collapsing to the degree that it did in the face of lower U.S. yields and, broadly speaking, a weaker U.S. dollar. That is a market signal that tells you that whatever inflationary concern may have been embedded in the price, in the hard assets price, it's been taken out.
If you think that today's move was about that, which we'll see, right? Gold has had weird, gold is, and you're right. If you could take the gold signal at face value, I would completely agree with you. And of course, it's painfully obvious that you're right. What troubles me with gold,
painfully obvious.
What troubles me with gold, which may actually be helpful to your exposure, is that it's been somewhat easy to veer off macro in the past, let's call it month and a half. We saw what happened with gold in between the Fed announcement and the election. It plainly said, I don't care about macro. I'm going to move on the election. And I'm going to go up just because I'm 2 weeks away, 2.5 weeks away from an election that bears a lot of uncertainty. And I'm going higher, even though yields are going higher, even though the dollar is getting higher. I don't care. I'm going higher. And we see now that it was election related, because the moment the election outcome hit, gold erased all of that in a matter of basically a week. It was all gone. And it snapped back exactly to where the Fed left it in mid-September. Then apparently we had this added uncertainty around the situation in the Middle East, the situation in Ukraine, and now we get a big letting out of the speculative air on that. Again, where we find ourselves again, back where the Fed left gold mid-September. So it seems to be kind of having a complicated relationship with macro over the past 5-6 weeks, where it listens when it listens, and it doesn't when it doesn't. If we're now back to regular gold, dollar and yields driven gold, and nothing of substance that's new comes out of the FOMC minutes or the PCE, this sell-off's going to look overdone.
Yeah, and what are we worrying about that we shouldn't be worrying about, and what are we ignoring that we should not be ignoring?
Any worry about war and as it relates to the market, I think, is misguided. It is whether it's in the Middle East or in Ukraine, which is not to say that the war isn't worthy of worry. It's just to say that war, I don't think there's any risk that war is going to be disruptive in the financial markets in the obvious places. And so anytime that percolates anywhere, like you talk about the Le Monde article, or even with, so there's obviously, as things sort of cool off a little bit, or I don't want to say cool off, as there's a path to potential dialogue in the Israeli side, we have the sort of bizarreness of the American and Russian escalation in Ukraine in the last chapter of Biden's presidency. But even that, I think, is still to be discounted in the same way that I would discount the Israeli activity. And then I think that inflation. I think there's. I don't know. I don't know if it's a good answer to your question, because you're saying, well, what should we be worried about that we're not? But I would actually argue that I think if inflation is under control, this thing's going to go hog wild. And so I think that the only thing to worry about is inflation. And I think there may be good reason to be worried about it. I mean, I was perplexed by your discussion earlier in today's program about the fact that we're going to be pretty quick to rate hikes if we sort of keep at this. And I just think that inflation is the reason Donald Trump, I believe the biggest reason Donald Trump is a president is because of inflation. I think people paying $50 at the diner. I just think that all these tiny little jam, like the $15 block of cheese, all this stuff is not to be underestimated. It's very real and it's very awful. Not that I think Trump has any authority or ability to do a darn thing about it, but I think an incumbent president who supervises that kind of inflation is doomed. And I think that is the sort of central risk in this entire economic apparatus. And so I think that, anytime there's a concern about global conflict in the financial markets, I think that that's logical and understandable, because I think we're all concerned about global conflict, but I don't think it's relevant to the financial markets. And I think maybe sometimes we get a little bit desensitized to inflation just because it's been such a pain, and it's been around for a while. And even though it stopped going up, it doesn't mean that the prices never came back down. It's still $15 just because it didn't go to $20 for a block of cheese doesn't mean it's not still $15 every time you want to buy a block of cheese, which is in and of itself ridiculous. So I would say inflation warrants more concern, and not just financially, but socially, and that war warrants less concern.
Ilya, what's your favorite chart? This week is obviously a weird week, but if you have one chart that you're looking at right now where it's the opposite of FUD, right? Where you're saying, you know what, I feel comfortable holding this. I want to do this. I would put it on today, tomorrow. If the markets were open on Thursday here in the U.S., I'd put it on Thursday. I don't care about the holidays. I like the trade setup. I'm going to give myself the time for it to decant a little bit here. What chart is that right now? And it doesn't need to be futures. It could be, don't bring up some, shit coin, please. I don't think we have it on the platform. But
I don't trade crypto, so no worries about that. The first one is ZB, and this is actually something I put on today. And there's that line that you and I set up there from Futures Power Hour earlier in the day. If you go to a 4-hour chart or an 8-hour chart, probably at this point, you see a clean break of that line. So to me, that's enough to take a little nibble. And the way that I did it was through just buying a TLT call. Just one, just to get a little skin in the game and see if maybe this is a turn that has some legs. They're cheap, and I gave myself plenty of time. So we'll see if this is something. The other one is the euro. If you look at 6E here, what you find is something that is basically on the dividing line between what is a correction or something with greater potential. You've rebounded, you've erased all of those losses on the soft PMI data last week, and you're basically sitting directly underneath where kind of the big sell-off, thanks to the repricing of the Fed, left you in that congestion, essentially right where we are now. If you can break back above the underside of that former range where you're testing now, you might have a greater pull-up in the euro. And even with U.S. markets, U.S. equity markets closed, currencies, first of all, remain liquid, not as liquid, but plenty liquid in the euro. And so you have ample opportunity for those markets to keep doing their thing. Moreover, there's some relevant Eurozone data this week. And the risk is that for the first time in a long time, Eurozone CPI ticks higher. So if that's what you get, and you already have a rate cut that's baked in for December, so there's not much damage to really do on a softer number, then maybe what you have here is some room for the euro to bounce and for the dollar to pull back more generally. I don't think that changes the trend. I don't think that changes me into anything other than an unrepentant, loud, and obnoxious dollar bull, but maybe not for the next few weeks.
The most interesting chart that I'm looking at right now is the 210 spread, which as of today is negative 0.002%. The curve's inverted again. Now, the mysticism around the curve, of course, is that every time it inverts, it means a recession's coming. Back in 2022, when it inverted, we were quick to remind everyone that it's not the inversion that matters, it's the uninversion. And after the uninversion comes, you typically go into a countdown where you have 12 months until the recession starts. Alas, we have to reset that counter. Is this a good sign, Ilya, that we've uninverted? Should we be scared about this? In July 22, when we inverted, that was 4 months from the low in equity markets. We've been on a 2-year plus bull run, effectively, during the course of the inversion. Is this perhaps the wall of worry that I should be looking for? Like, should bulls be happy that we're seeing this because now it's a new thing for people on CNBC and Bloomberg to freak out about, that the curve's inverting again, so this must mean something terrible for markets?
I don't think you can read this as necessarily encouraging at all. I don't think you can read it as discouraging, per se, yet. We'll have to see. There's, as we just talked about a second ago, there's been a massive move in the bonds today, and the stock markets didn't care one way or another. It's a massive move in bond derivative assets today. So assets also part of the kind of interest rates in the U.S. story, metals and the dollar. Nobody cares. So we have to, as far as equities go, so we're going to have to see, I think, whether equity markets come around to paying attention. I don't think anybody should be particularly enthusiastic about the fact that interest rates in the near term, which is how we're moving here, that interest rates in the near term are going to be higher, relatively speaking, even if the expectation downwind, and which is why we're seeing the sort of flattening, is that rates may not be as high as people thought maybe a week ago. That's not happening for economic reasons. It's happening because a degree of sovereign risk came out of the bonds with the Besant news. This is not anything that means anything as far as how much scope there is to cut or there isn't to cut. The Fed odds haven't really gone anywhere if you look at Fed funds futures. So I don't think risk appetite really ought to be particularly excited. Having said that, the Besant news came and went. We don't know what the meat around those bones is yet, and won't probably until well into the end of the first quarter, as the new administration takes shape, as some of its actual policies start to occur. So I wouldn't get overly excited if you're bullish that the curve has inverted again. I don't think this is anything to celebrate necessarily.
I don't think it's anything to celebrate either. Dylan, we have 90 seconds left. You take us out with the final closing thoughts around the world. What's your biggest concern or source of confidence here?
I'm an optimist. I mean, listen, we've survived some of the biggest volatility-inducing events that any population can endure. We've been through a couple years of war in Ukraine and Russia. We've been through catastrophic war in the Middle East for now 13 months, and we've witnessed yet another peaceful transition of power in the United States. We've navigated inflation. The labor market is intact. or we navigated, I should say, the big inflation scare and the rate cycle. I don't know if we've navigated inflation, and the labor market is intact. The technology boom is at an all-time high. I think that there's huge opportunities across the entire technology spectrum right now, not just computer tech, biotech, educational tech. I mean, there's just going to be layered robotics. I think it's going to be never ending now for the foreseeable future. And so I actually feel very optimistic, if only in the resilience and durability of what we've been through and who we and where we are collectively. And I think that the financial markets reflect that. And I think we're set up for a very nice period between now and the end of the year, both in the financial markets and I hope socially for everybody, as we hopefully look for some on-ramps where there's conflict and to look past the anxiety of this presidential election, which has held so many people in America, frozen or anxious for well over a year before it happened. And so I hope that there's some relief in looking past that and into things that are both closer to home individually, people that are near us and around us and that are important to us, and also more broadly optimistic on the technological and cultural side, because I think as we flip into 2025, we're going to get a lot of the sort of a lot of the good things about the future that we'd hoped for are going to start to really manifest.
Well said. With that, Overtime is now out of time for this Monday, November 25th. We'll be back tomorrow, same time, same place, for the only other episode of Overtime this week. We're off the rest of the week for Thanksgiving, so if we don't see you tomorrow, hope you have a good holiday. Good luck trading, of course. But if you're going to see us, then we'll see you in 24 hours, or rather 23 hours time. For Ilya Spivak in San Francisco, for Dylan Radigan in Milan, I've been Chris Vecchio in New York. Good luck trading. Stick around, though. After a brief break, Tasty Live is back with Ilya Spivak and Macro Money.
See you there, everybody. The markets get a nice little bit of optimism as the week begins, but ultimately do very little with it. That's if you ask equity markets, but movement is certainly afoot elsewhere in the macro universe. Bonds are higher, the dollar is lower, and a strange bit of life has emerged into one of the most unloved markets over the past 2 months. The euro manages to climb from the lowest in 2 years. The question we're going to be asking ourselves on this shortened week with very little to do on the U.S. side as things wind down for the holiday is, can we maybe get some action in the euro and the currency markets this week? This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we're going to take a look at how it was that the euro got here and what happened to give us this move, and then consider where we might get the catalysts for this to continue. And the place that seems to make sense to start is first and foremost the positioning itself. So if we take a look at what seems to be going on here, the first thing that comes to mind is that we're looking at a situation here where the euro seems to have found an important inflection point. Take a look. This is 6E futures here, the active contract, and we had a appearance of a clean technical break last week. There's that area there marked by the March and the October lows from last year at about 104.80 to 105.30, let's call it. So centered within about 20 pips this way or that around the 105 figure. That's this right here. We stalled at that level in this long 2-month decline for the euro that was ultimately characterized by what was going on the US side of the ledger rather than anything with the euro per se. And of course, that story ought to be a familiar one. It really has the most to do with what's been going on with a reshuffling of Fed policy expectations. And as ever, we see this is something that we've unpicked quite extensively over the past several weeks, but we'll do it again to make sure that our context remains in place. We've had now basically the better part of 2 months where the market essentially took the mid-September Fed policy announcement and said all of the dovishness that seems to be on display here is probably going to be inflationary in the context of an economy that is at this point not looking especially weak. And that then creates a situation where we've seen a lasting rise in the dollar, a lasting move higher in yields. You can see that very clearly here. Again, a bit of a busy chart, but one that tells a clear-cut story. At the top here, we have inflation expectations as baked into bond markets, break-even rates. These are the difference between nominal and real interest rates. We have a steepening of the yield curve shown by the uninversion of the 10 to 2-year yield spread. We have a clear-cut march higher since about the middle of September in yields across the curve, the 2s, the 10s, even the long end. And of course, a strong rally in the dollar. All of this to say, the Fed is giving us a 50 basis point rate cut. They're telling us that we're going to get 150 basis points in further easing beyond that. Meanwhile, the economy is growing between 2.5% and 3% annualized. This is not the kind of situation where aggressive stimulus is going to leave inflation as it stands. Rather, this is something that is likely to crimp the Fed's ability to ease in 2025 because their actions now will be inflationary. And so against this backdrop, you get an extended decline in the euro against the dollar because the dollar itself is on the move. You get a kind of crescendo in the story last week with absolutely abysmal Eurozone PMI data. And that's what you see right here. There is the expectation that the economy will put in a modest second month of standstill. As ever, PMI data is centered around the 50 level, where 50 is neutral, neither expansion nor contraction. Above 50 is expansion. Below 50 is contraction. And the expectation was that for the second month in a row here, we can see there's October at 50 on the composite index that subsumes both services and manufacturing, that we'd get another month right there. What we end up with is a dramatic slowdown in the service sector, which falls back into contraction territory, 49.2 against expectations of well over 50, and that takes the composite down aggressively and gives us the worst outcomes that we've seen essentially in a year almost. So what we're looking at is deeply disappointing economic data, and not surprisingly, the euro behaves accordingly. and jumps all the way down here to probe under the 104 figure and hit this low from May of 2022, which is the next sort of major inflection point there, 103.62. And then the markets rebound. Not because of anything that happened on the European side necessarily, but rather because the dollar takes a big step back as bond yields cool off today, seemingly around the news that President-elect Donald Trump has nominated Scott Bessent, a longtime macro hedge fund manager, alongside the likes of George Soros and Stan Druckenmiller, who's built his own macro hedge fund that's been successful for decades now, to the post, very influential post, of Treasury Secretary in the new incoming administration that's going to take the reins early next year. The market seemingly taking that as a positive sign, as an indication that there'll be a steady hand at the till, as it were. Scott Bessent, whatever you may think of his opinions this way or that, or what ultimately becomes the policy that he executes this way or that, is certainly somebody that's intimately familiar with the machinery of global financial markets. And so he is a very experienced hand in the role that he is being tapped for. And of course, in having run a business, he's also run a somewhat complicated organizational structure, and that is a relevant skill set to running the Treasury Department also. Not a perfect skill set, of course, not exactly the same, but after all, what is? And so with that in mind, the markets seem to look at this and said, okay, this is on balance good news. And so a degree of sovereign risk around uncertainty linked with this nomination seemed to come out of the bonds today. That pulled U.S. yields lower and gave the U.S. dollar a little bit of a knockback in that it tightened its yield advantage against other currencies. Very tellingly, the euro does not make a key breakout here, but comes right to the underside of where it broke down last week and holds right there. So the key question from here is, are we now done? Is this rebound over? Or perhaps do we have scope for something a little bit more significant? Even something like this, a bit of a wiggle higher here, maybe toward the 106 figure or something of the sort, to relieve some of the recently aggressive selling, and perhaps then and only then set the stage for the next leg in whatever this larger decline is going to look like. And an argument in favor of a larger bounce, in particular this week, begins with a look at incoming Eurozone CPI data, which is expected to show, for the first time in a long time, a sizable back-to-back bounce. The expectation is that we're looking for a year-on-year inflation number at 2.4% year-on-year. That would be the highest that we've seen Eurozone inflation since July, and the second consecutive increase, which is not something that we've seen in quite some time for the Eurozone. So the ingredients seemingly are there for at least something that doesn't make the euro situation worse after that extrapolated 2-month sell-off. In fact, if we look at the makeup of the situation in the euro area, we see that, at least as far as the latest numbers are concerned, most inflation continues to linger in what you might say are discretionary spending categories. Miscellaneous, obviously, is a difficult thing to make heads or tails of. There's a hodgepodge of all kinds of things in here, but the real big lingering influence is hospitality, restaurants and hotels. And one might reason that with the economy clearly doing this, that is to say, shrinking once again after an aborted attempt out of recessionary conditions earlier in the year, that discretionary spending will go with the business cycle. And as the business cycle now gives you a cool down, so too discretionary inflation will come in because the discretionary spending will be crimped. If we look elsewhere here, there's really not a significant concern. And indeed, there's not much that needs to be undone. If a full 50 percentage points of October's inflation number is being contributed by hospitality, you could go quite a long way toward the ECB's target 2% by even trimming that in half. And so, with that in mind, the pathway forward for the ECB seems unmistakably dovish any way you slice it. In fact, if we look at expectations as they appear in benchmark ESTR futures, we can see the market see 22 basis points in further easing baked in through the end of the year. So that's about an 88% chance that we're going to get another cut in December. And then about 100 basis points, that is 4 more cuts, are priced in for next year, which is almost double that which is currently in the forecast for the Fed. So that the euro is looking at a significantly more dovish rates profile than is the dollar, that much is clear, and that the structure of inflation suggests that bias won't change, that too seems clear. In fact, we can see here what's happened with the current evolution in policy expectations is that here's September, then of course there's October's rate cut from 3.5 to 3.25%. The pathway since then has only become moderately more dovish. And so what we have here is a shallower sort of curve currently than what we saw when the ECB last met or the time before. So with incoming information, the markets have only become more convinced in a dovish ECB. And frankly, with the economic data the way it's been going, rightfully so. So how does all of this comport to a euro bounce? Well, the question, as ever, is what has this information done for us lately? All of this is ostensibly in the price already. There's really not much that isn't already reflected in a euro sitting as low as it is after this extrapolated decline. So which part of that story is not in the exchange rate already? Well, a disappointing inflation number, perhaps. However, we look at the way that Eurozone economic data has performed relative to forecasts since late September, the trajectory has been toward improvement. That's not to say the data has been good. In fact, the PMI numbers last week are a shining example of data that not only wasn't good, but surprised down, not up. But on the whole, we can see that over the course now of almost 2 months, Eurozone economic data outcomes have improved relative to forecasts, and in sitting above 0 on this Citigroup index, narrowly suggest that the path of least resistance, or at least the place where surprise risk is concentrated, is on the top side. If that gives us a somewhat warmer CPI number here, that may be enough for the euro to find speculative exhaustion out of sellers, where they look at this extended move and say, well, sure, the ECB is going to cut. It's almost all the way baked in already. There it is. 22 out of 25 basis points of a cut are already there. Not much room for anything else. We know that there's already an extensive rate cut cycle on the menu for next year. Were we to get a very weak CPI number, maybe that number could move out. But if we got a pop, at the very least, there's nothing there to make that 105 basis points look like 110 or 120 or 130. If nothing else, it stays as is. And so the question becomes, well, which part of that isn't in the euro a hair from 2-year lows? And if in fact the surprise is on the other side, as the recent dynamics have suggested, PMI of course notwithstanding, then we have a situation where you might have the catalyst for the markets to say, you know what, there's been a lot of speculative money to be made short the euro, and maybe that window has closed for however long until there is not a new catalyst to shift the balance. And that may be enough for a round of speculative repositioning, if nothing else, which could be just enough fodder to give us a euro back above this barrier here, resting somewhere in the vicinity of the 106 figure. And to the extent that that looks like a reversal, it may yet have follow-through potential, at least in the near term. Moreover, the dollar side of the ledger may actually be somewhat helpful. Obviously, we've had 2 months of this already. We are looking at some reinforcement of it, first with minutes from November's FOMC meeting, where, as we looked at in detail last week, there seemed to be a more hawkish admission sort of rhetoric from the Fed, where they seem to dilute the more rabid dovishness of September and say, well, looks like the markets are angling toward a reheating of the economy. Just so we're clear, we don't intend to jettison our 2% inflation target or declare victory in a premature way. We're not in any kind of hurry to cut. We heard this reiterated in a speech from Fed Chair Powell a week after this meeting. Then later on Wednesday, we're going to get U.S. PCE inflation data. And here, the expectation is for a pop that would essentially give us a 4th consecutive month without disinflation on the Fed's favored inflation gauge, the core PCE number. But of course, these numbers tend to be relatively easy for the markets to forecast, as we have the situation now with the same period's CPI and PPI numbers already in the books. It's relatively simple for the markets to back out what PCE probably looks like from those releases. So the level of surprise risk here seems moderate. If the minutes from the Fed don't essentially give us anything more hawkish than we already know to power this narrative to new extremes, and if the PCE numbers register somewhere within striking distance of expectations, yes, that of course will suggest that the Fed is probably going to be restricted in terms of its easing cycle. In fact, we can see that here, the high frequency annualized rate, the 3-month annualized rate here has actually been going higher for PCE over recent months. And of course, September saw a meaningful month-on-month increase, suggesting that indeed the Fed is going to have its hands somewhat tied next year, or more so than even they anticipated. But we've already seen that accounted for here. And so what we need to see is something truly remarkable. The minutes would need to say something nobody has bargained for yet, which seems unlikely. And the PCE numbers, would have to wildly overshoot expectations, which is, of course, possible, but again, unlikely, given the market's track record of forecasting PCE with CPI and PPI in hand. So, absent a hawkish surprise on the dollar side, and with a bit of a supportive wiggle from Eurozone CPI on the other side, what you may well end up with is all of the fuel you need for a euro correction. Not for any reasons of structural change, but just of speculative exhaustion. And that is macro money for today. As ever, we are usually here Monday through Thursday, but only today and tomorrow this week because of the closures in the U.S. for the Thanksgiving holiday. We come right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. On a typical week, I'd be on with Victor Jones for The Price of Truth on Wednesdays, on with Chris for Futures Power Hour Mondays and Fridays, though not this week, and writing for the news and insights portion of tastylive.com. That continues. And finally, opining sporadically on both the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow.
Oh, yeah, it is Monday, November 25th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. One view. Oh, that was wrong. Explore the incentives that govern our world. What's going on, everybody? Happy Monday. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of the conversation, and today will be a solo show, highly participatory show, and get your name or screen name somewhere. Did I get it? Did I get it? On the screen here, as well as your comments. There's only one place to do it. Head on over to the soon-to-be reformed Google YouTube. Type in Tasty Live, go to the channel, find this big head on a big red thumbnail somewhere. Jump into the chat and start typing in random-ass characters, man. Anything you want, whether you made money, you lost money, whether you're loving that little bond rally here today, whether you found it strange. What is in front of my face? Whether you found that strange, a little NASDAQ squadouche here today. NASDAQ squadouche. And the Russell ran. It was probably about time for another one of those moves. It never lasts, though. It's like a 5-day Russell versus NASDAQ ripper, and then it always dies a slow death. We'll see if it's got a little bit more legs than that. Speaking of the people, we should say what's up to the people. Everybody in the YouTube chat, I love you. Cato Prom, Cato, what's going on? David Lang, Lone, Soul Train, Donna, Buffalo, Brian, Sleepy, Martin. So many names I get to see every single day. It makes me happy, quite frankly. H. Montero, McNutty, what's going on, everybody, and so many more. I would say here, as I've told you many times before, and just shout out names on the chat, but I'm told I'm contractually obligated to stop doing that. So I'll get as many of you as I can before we get ripping and running. One of these days, it shouldn't be a chat, you know? Just you guys get to type in and I get a microphone. We got to figure out how to do this with like just a viewing lounge, you know? Everybody, you can see your faces on screen. Oh, most of you, I'm sure, are fully dressed and appropriate, but some of you I'm a little bit nervous, quite frankly. Some of your commentary, I'm a little bit nervous. Lone, you're a good man, my friend. All right, let's get going a little bit, shall we? What a wild weekend. Wild weekend, lots to talk about. Big week, I kind of think from a macro point of view, not from an earnings point of view, we'll try to cover as much as we can. NASDAQ, cash. Victor, why are you so focused on NASDAQ? Well, because that's where my positioning is. NASDAQ up 14 basis points. The Dow Jones up 1%. Congratulations. Grandfather's favorite index is not the underperformer of the day. Second highest performer on the day. The Russell up 1/3%. Excuse me. That's S&P up 1/3%, and the Russell, the outperformer, cash was up 1.5%. Futures were up nearly 2%. Vic, you sound better. Yes, I feel better. I feel better. That little, I don't know what that was. A little 2-week kind of face monster. It is gone. It is gone, my friends. Bond market really likes a guy concerned about the deficit. We'll talk about that in a little bit. But a decent day for risk. Even the thing, being short, I think at the indice level, obviously didn't pay off. It didn't hurt. It didn't hurt to be short the Nasdaq. So for that reason, I will. I'll be a little cheerful. It didn't hurt to be short the Nasdaq. And I said at the end of last week, I said it on Twitter a few times. I don't know if I said it on the show. I'm pretty sure I did. End of the week, a little short Nasdaq and a little long bonds. I got longer on Friday. So today was it was an okay day on bonds. Okay day overall. I wish I had some long Russell like you guys. Robert Booth said this is better. They have the nasally thing. That just is what it is. One of my I don't know what these are called. Nasal passageways. What's this bone called right here? One of you've got to be a surgeon. One of you out there is a doctor. Whatever this thing is, just got collapsed in from scraps as a young man. So that nasally voice, you can't fix that unless I do that surgery. But anyways, S&P 500 a little bit higher than 6,000. It's going to be a holiday week on light volume. You've heard that probably 100 times on a Trader Network. You're probably not going to hear it on mainstream or bigger platforms, but it's important because it'll probably speak to the lack of liquidity. Lack of liquidity, you get a little bit of jump risk potential towards the end of the week, which is sort of what you sort of think the opposite, right? You sort of think holiday weeks, you'll get sort of a slow week. Things won't move. But I think if you've been doing it a while, you understand that less liquidity met with some sort of catalyst or somebody's got to work out of positionings creates jump risk in the market. And I don't know. If it's in your favor, it doesn't really matter, though. VIX, sub 15, man. 1460. Another VIX crush here today. Yes, I am calling 60 cents lower in VIX cash a crush because it is a little bit more than 4%. That's a big deal where I come from. Lone says same thing. Yeah, you got a couple of kids that came from the wrong side of town. A couple of you guys have the same problem as me. We all sound the exact same. It'd be better. It's better. You know, it's a good thing. Nasally is better than sounding like the Simpson sisters. You know, because that would mean I went a different path with my youth. Forward size VX, VIX futures still above 15, so that basis between cash futures widened up here today. Sorry, checking the date, trying to figure out whether we're approaching expiration or something like that. But I think the big story here today, my good friends, is bonds. We moved higher really across the curve. 2-year jumped. 2-year jumped here today. 10-year jumped. I didn't see the 5-year. Anyone else trading the belly of the curve out there? You're a warrior. You're probably, you know what I mean? You're probably an old Solomon guy if you're trading everything throughout the belly of the curve included. But everything moved. The 30-year move, we're up about 2 points. I don't know. We might have been like up 1 and 31, 30 seconds, something like that at the close. But I think we're up around 2 points in the long end of the curve. And then UB, the ultra bond, was up more than 2 points. So just I don't want to say massive. Okay, I would be overdoing it. A decent rally in the long end of the curve, given the absence of buying we have seen for a pretty prolonged period of time. This move, though, hasn't been without a few 1 point, 1.5 point rallies. It's not as if we haven't seen that since September 17th. We have, which is the date of that first cut. Surprise, surprise. We have seen a few of these, but they were sold quickly. I mean, I don't think we've put together more than 2 days of bond rallies since then. if I'm not mistaken. I don't think there's been more than 2 days of bond rally. So I am curious. That's your nose, bro. That one got me, Robert. Sepia. Is that what this is? Sepia. I knew somebody would know it. Soul Train with the win. Soul Train for the win. Go buy a lottery ticket. Let's quickly look at the curve here. Let me refresh this. Let's quickly look at the curve. There we go. And just, I like to do it in context just to try to show the shape for people who are visual learners out there. If you're not following on a day-to-day basis, it can be hard to sort of put this visual picture of the yield curve in your mind. Hopefully it helps. I don't know, for some it might be repetitive. My apologies.